Good evening, everyone. I hope I'm visible and audible to all of you. May I get a quick confirmation over the chat box? Am I audible? Visible? Awesome, great. So, guys, today we are going to practice section A and B questions. Okay. So, this is FR marathon, financial reporting marathon. So, don't confuse this marathon as syllabus practice class. I mean, don't think that I'm going to discuss merely the standards with you like I usually do in my grand revision. That's a separate thing which we will do just way before our exam, like 1 or 2 days before the exam. We will have a free of cost session on YouTube, which will be for IFRSs, right? Where we will discuss all the standards. So that is a separate session. Today we are going to see how we are supposed to practice the MCQs, and by these 50 MCQs which I have picked up from your Kaplan kit only. So if you guys are following Kaplan kit, if you do these 50 MCQs with me, so if you have around 300 or something MCQs, 50 would be done today. So remaining would be pending. So these 50 MCQs are from the Kaplan kit, which we will do today. And I will discuss whenever with an MCQ there's a concept. Of course, I would revise that concept if that would be a difficult MCQ. So that would also act as a revision for you. So before I begin with it, I want to give few points of sessions since we have around a good number of students here. So I want to just write that if you are having any doubt, first let me complete that particular question, okay? And please be active throughout the session. I would ask you guys to calculate stuff. I don't have any calculator. So I'll give you the formula, you will calculate, and then that's how we are going to move ahead. Okay, so we are going to do the calculations on the chat box. You will tell me the calculations. Everyone should have a calculator in hand. And secondly, if you have any doubt, let me complete that question. Then I ask you, are you guys clear? Then you have to ask your doubt. Okay, so that's how we will go. Am I audible, right? I'm audible. Mohammed can't hear me. Am I audible? Hello, mic check. Yes, okay, awesome. Yes, the session is recorded, and after the session, where you can find the recording of it on my YouTube channel by the name of Tashruta Gupta. And this is our FR marathon, and we just have 1 day for it. Next time, when we will meet for any free session, it would be on syllabus at a fast track speed. So let's get started. I'll just give you, first of all, the input into what is important for your paper and what is something which you can say is most likely to be tested in all the three sections. So since you guys have, reached this level of your preparation, so I am damn sure that you guys are done with majority of your syllabus areas. That's why you're here today. So what we have is in our FR, we have a proper format. What's our format? There are three sections: section A, section B, and section C. So in my section A, I am tested objective test questions. So they are objective test questions. And these are independent questions. That means question 1 does not relate to question 2. So these are like very fun questions, I believe, because if you don't understand one MCQ, your headache is not increased that in the second MCQ also same kind of a thing would be asked. So if a question is, let's suppose, on financial instruments and we are not good in it, and we are not able to deal with that question, fine, okay, works, you can move to the next one. Then section B, here we will talk about a case study. Now, not a case study where I have to theoretically solve the things. It will be related to MCQs only. So one piece of information would be given to me, and beneath that there would be 5 MCQs which I have to answer. So that is my section B. My section C, guys, what's there in my section C now? In the section C, we have 2 questions which will be tested. That is for sure. So these are 20 marker questions. So question 1 would be 20 marker. Question 2 would be 20 marker. So section C questions, first question I predict and I hope comes from group accounts, but sometimes it's also from single entity. So we cannot, cherry pick and say that, okay, we'll just do group accounts, we'll not do single entity. So what is single entity? When I prepare P&L balance sheet, OCI of just one company, that is single entity. When I prepare it for a group of companies, that's group accounts, where we make those 5 working notes, where we have a parent and then we have a subsidiary. So that is basically our group accounts. So what I want to discuss is that these two, there would be either group accounts or single entity. And for the rest of the 20 marks, you're going to get interpretation question. Now, I really want to revise this topic, interpretation, with my YouTube students as well, the students who are preparing by themselves, right? So, these interpretation questions, I would be uploading a video on this where I will discuss the tips and tricks of interpretation and I will solve a question with you on my YouTube channel as well. Plus, in that, I am going to add earning per share because these are the two topics I am yet to complete with my batch also. So whatever I'll be doing with them, I'll also upload on YouTube channel just because I believe that these two are little difficult topics and they need some kind of guidance. Interpretation is not difficult. Interpretation is common sense. It's just that we need a little guidance on how to write the answer, right? So that's what I would do for like in free self-study groups. We will be sharing these two videos with you. So this is our format of the paper, section A, section B, and section C. So section C, I'm going to revise with you in form of interpretation questions. And today I'm going to revise with you section A and section B. Now, what part of my syllabus is the most important? Which standards are most important standards in our FR syllabus? That's very important to know. And one student has asked, when will you give Super 20 questions? By the end of this session, I'll give you a list of Super 20 questions, don't worry. So what do we have in our standards? Which is the most important? By now you've practiced. What do you think? Which one is the most important one? Which are you finding a little difficult or you think every time I open Kit, this standard is always there? Something about this standard is always there. Which one do you think is very important for FR? Or what do you think when you are preparing that you always find this question somewhere? Revenue. Okay. What about any other standard? That's right. I really believe that our whole FR paper is made up of IAS 16, or in general, if I talk about the full unit of non-current assets, where I have IAS 16, I have IAS 38, I have the investment properties, the borrowing costs, the non-current asset held for sale, the government grants, IFRS 5. So these are something which are very, very important, and whether you pick up group accounts, you will find it. NCA would be there. You pick up single entity question, NCA, one working note from NCA is always there. You pick up MCQs. There was one attempt where my students gave me the feedback. My whole paper was made up of IS 16. My whole paper was made up of non-current assets, especially the MCQ portion. So that means it's very important for us to understand that this NCA portion is where I need perfection, right? And second most important is my IFRS 15. Okay, they are equally important. IFRS 15, IFRS 9, and IS 12. Defer tax. Where do I find defer tax the most? I find it in single entity 20 marker question. And that is never, single entity is never there without deferred tax. They will talk about current tax provision for the year. They'll talk about charge for the year. Then they will talk about the deferred tax. They'll talk about under or over provision. And you will have to adjust. Either you're preparing P&L or you are preparing your balance sheet. Whatever you're doing, you're supposed to know deferred taxation. So that means these are the most important standards in my curriculum. So what do I have to do now? I need to devise a strategy with which I am emphasizing on these first. So if you are in your revision stage, if you are like just starting with the syllabus, because I know such students exist. So whatever stage you are at, you've done it once, you are revising second time, you need to make sure that these standards are on your priority list. Second important unit is group accounts. Now groups we all know, consolidation. How do we consolidate? How do we prepare group P&L, group OCI, group SFP? Cash flow is not there in your syllabus for groups. So this is what is tested in 20 marks. You might even encounter MCQs on this. Sometimes they don't ask it in section C, then they'll compensate you with the MCQs on group account. So they don't leave groups. They know it's very important topic. So they would sure be asking you about group accounts. And then another is interpretation. Now, what does interpretation requires? The ones who have covered interpretation, you must be wondering, ma'am, how should we practice interpretation? What's the syllabus of interpretation? It's like just formulae of ratio, what to do, how to do. I mean, they give us a case study, we can calculate the ratios. Ratios is something we've been studying since long. We all know what is profit margin, what is net profit margin, what is return on capital employed. Maximum we can do is we can mug up the formula of these. But what do they want from us in the exam with those case studies? That 20 marker question. So this is what I'm going to teach with a recorded video on YouTube. The skills that you need to develop a good answer in interpretation, and the tips and the tricks to make an answer with one question that I'll solve in the class itself. So the interpretation question is common sense. It's just about, you keep an accounting compass that this particular company has this performance going on. They have this much profit. This was their revenue last year. This is the revenue this year. These were their cost of sales. These are their cost of sales this year. Then you do the trend analysis. That means you'll figure out how much my revenue has increased versus how much my profit has increased. So it's all like, analytical skills that you have to apply, which comes from within. It's not something that I'll read something and I'll be able to develop it. No, it is going to come only if you solve this question with an open mind, with pure common sense, when you have a fresh mind. That's why in FR we say, by the time you reach this question, you are under time crunch. By the time you reach this interpretation question, you would be in time crunch and you will be like, what to do now? My mind is not working. If that happens with you, you want to be able to crack this question. This is why it's very important for us to manage time in FR paper. So time management is very important. Can anyone tell me what's our time management skill in ACCA exams? How do we manage our time? Come on. How do we manage our time in ACCA? What's our time management technique? 1.8 minutes per mark. 1.8 minutes per mark. Very good. So if I do 1.8 minutes per mark, you guys will tell me if my section A is for 30 marks. For my section A, how much time should I give? 30 into 1.8 minutes. How much time should I dedicate to section A? Yes. 54 minutes. Very good. So 54 minutes to section A, 54 minutes to section B, and then lastly to my section C, I am supposed to give how much time? It's 40 marks. So 40 into 1.8, 72 minutes. So I need to leave approximately 1 hour 15 minutes for this section C. Do we have negative marking in FR? Do we have negative marking in ACCA at all? Do we have negative marking? No. So if any question in my section A and B is bouncer, I'm not able to understand what should I write in this question. So should I bang my head on that MCQ and waste my time and exceed this limit? Or should I just do guesswork? Educated guess. Have we guys not been making educated guesses in our lives? Most of the times we make guesses. Then what's the problem in making the guessing in the section A and the section B? You can do that. So if you feel that there's a question and it's very bouncer, like it's totally not understandable. It happens. There are bouncer questions. In professional level, you will see 30 marks bouncer question. Okay, so in FR, you might find 5 marks, 2 marks MCQ, which is bouncer. So that's okay. Accept it. It's a professional qualification. So you need to just guess and move ahead. because you don't have time to waste, because you know that I just have 72 minutes in my section C, and my interpretation, ma'am told us, interpretation needs common sense. And if I will be exhausted, if I will be under time crunch by the time I reach section C, by the time I reach interpretation, my common sense would give up and I won't be able to perform well in interpretation. So this is my technique. I suggest people to start with section A only, because they are unrelated question. If you are stuck in one MCQ, you're only stuck in one MCQ, where you can do the guesswork and move ahead. Same with section B. At the end of the day, it is also MCQ. So they both will give you 60% of the marks. They have 60% weightage. So first, let's get done with them. Then in section C, make sure you have that 1 hour 15 minutes for sure. Okay, 1 hour 15 minutes are just for section C. So this is my strategy to pass FR for the time management component. Now let us get started with our MCQs. Before I begin with it, is there any doubt with regards to strategy? Is there anything you want to ask? Please drop it in the chat box. Yes, this session would be uploaded on YouTube. It will be uploaded tomorrow. Awesome. Okay, so we are all good to go. Let's continue. Let us check the MCQs which I want to cover with you. So you all know this is your Kaplan. My students follow Kaplan. What about others? There are many students here today. What are you following, Kaplan or BPP? Interpretation will be uploaded day after tomorrow. Both BPP, Kaplan. Kaplan. Okay, good. So majority are following Kaplan. Even if you're following BPP, fine. Works also. You can do some extra questions with me today. So I'm starting from the section B. Okay, I have circled some important questions, MCQs. I've not done this randomly, but I have done this by looking at the questions. Of course, I cannot cover everything in one session or every MCQ in one session. So we are just doing important ones, cherry picked ones. But you are supposed to do every MCQ. MCQ is something you all can practice anytime. Pick up 10 MCQs in the morning, 10 MCQs in the evening. It's like a dose. So today I'm picking up 50 MCQs dose. So let's do. So here they're saying what will be the consolidated, what will be the consolidated, okay, retained earnings at 31st December 2015. So they are giving me that my year end is 31st December 2015 and I'm supposed to calculate my consolidated retained earnings. That means group retained earnings. Which working note? Which working note? Where do you calculate GRE? Which working note is that? I've already uploaded a basic group accounts lecture you can find on my YouTube if you are struggling with basic groups. Very good. Working note number 5. So working note number 5 they're asking me. So on 1st January, that is in the beginning of the year, Prunier acquired 80% of this company, $2 million, one ordinary shares. So 80% means I am the parent, Prunier is the parent, this S company is the subsidiary. By how much? 80%. So at this date, the subsidiary had retained earnings of 4 million and revaluation surplus of 2 million. Prunier had retained earnings of 10 million and a revaluation surplus of 5 million. So how am I supposed to calculate? How am I supposed to calculate the retained earnings? See what you will do. You'll simply, let me just share the dual screen so that on the one side I can solve and one side we can see the question. Okay. So what will we do here? I hope it's visible. Can you just give me a quick confirmation? It's visible. Both the screens are visible, the board and the kit too. Awesome. Okay. So what will I do? I will say that what is first of all subsidiaries post acquisition movement. So how do we calculate our group retained earnings? So our working note number 5 says we need to take parents retained earnings, right? I need to take parents retained earnings. Then I need to take the parents share in subsidiaries post acquisition movement of net assets, right? That's what I need to do. So they have given me at the acquisition date what were the retained earnings and what was the, they've given me at the acquisition date, subsidiaries retained earning was 4, revaluation surplus was 2. But then what was it at the reporting date that we need to see? So fair value of subsidiaries net asset at acquisition were equal to their carrying amount with exception to a property which had a fair value of 8 lakh. So there was a fair value adjustment, right? And this will lead to additional depreciation, which we will calculate because they have given us remaining life is 20 years. So there's a fair value adjustment of 8 lakh and additional depreciation would be calculated on it. Then at the reporting date, parent and subsidiary both have revalued their assets. Parents' assets have increased further 2 million, while Stringham's increased by 5 lakh. At this date, Premier's retained earnings were 11 million and subsidiaries were 3.5. So how will I calculate my share of retained earnings? How will I calculate this? So I'll simply say what is the post acquisition movement. So post acquisition movement is from 4 million, the retained earnings have decreased to 3.5. So what's the loss during the year? From 4 million, the retained earnings have reduced to 3.5. So what's the loss? Yes. What is the loss? 500 is the loss. Loss is 500. Awesome. Now, if you talk about this post-acquisition movement, from which working note do you get this post-acquisition movement? From which working note do you get this post-acquisition movement in consolidation? Working note number 2. Very good. So we get this from working note number 2. So what's there in my working note number 2? If I just make that as well, what's there in my working note number 2? What are my subsidiaries' net assets? So they've just given me that there was a fair value adjustment. So this fair value adjustment is adjusted in which column? Acquisition date column or reporting date column or both? Fair value adjustment of subsidiaries net assets happen in acquisition column, reporting date column or both? Both. So I will add 800 over here and I will add 800 over here. This gives rise to additional depreciation. So this additional depreciation affects which column? Acquisition date column, reporting date column? Just the reporting date. Just the reporting date. So what's the life of the asset? Life of the asset is 20. What is 800 divided by 20? What's my depreciation? What's the depreciation? 800 divided by 20? 40. So the depreciation is 4040. So how do you calculate your post-acquisition movement? Post-acquisition movement is the third column in working note number 2, where you simply say reporting date minus acquisition date. So minus 40 minus 0 is minus 40 only. Yes. So what do I get? I get a loss of 40, which needs to be taken into account in the post-acquisition. So my total post-acquisition loss is 500 plus 40. Am I right? Total post-acquisition loss is 500 plus 40. That is 540. So in your working note number 2, you would be getting this. Like you can even put your retained earnings over here. That my retained earnings at the acquisition date, subsidiaries retained earnings at acquisition date were 4 million, right? So 4 million means 4,000. Then it was 3,500 at the reporting date, which gave me a loss of 500. So my total loss is 540. Post acquisition movement is 540. So in which, amongst which will this loss will be divided? Who will have a share in this loss? Who all will have a share in this loss? Yes, in this 540, who all will have share? NCI and parent. Very good. So working note number 4 will be impacted and working note number 5 will be impacted. So what is the parent share? That's what we are calculating. We are calculating working note number 5. So what's the parent share? Parent share is 80%. So 80% of 540 is how much? 80% of 540 is 432. So total loss allocated to the parent is 432. So whatever parents retained earnings at the reporting date, they were 11 million. That means 11,000. In that, I will deduct 432. Come on, tell me how much do you get? This is your group retained earning. How much are you getting? 11,000 minus 432. Very good. 10568. So what is my answer here? Can we find 10568? Be the Dora the Explorer. Can you see 10568? Yes. Option D is my answer, and that's the correct answer. Option D. Done? Are we all clear on this question? Are we all clear on this question? How did I get answer D? So we need to think about the working notes, we need to think about the formats, and then we are supposed to do the calculations, correct? Let's move on. Okay. Now, what will be OCI attributable to the parent for the year ended 31st December? OCI. So, what do I have with regards to OCI? Revaluation surplus goes into OCI. First, in the first part, they asked me about retained earnings only. So you do not touch revaluation surplus in retained earnings. These are two separate jars. They are two separate words. So they just asked about retained earnings, right? Now they are asking about OCI. So what is affected? Which balance or which transaction impacts OCI? Revaluation? Yes. So revaluation is something that they are asking me. So what will go into other comprehensive income? Let us tell the examiner what is going to impact the OCI. What is my, they are saying what will be other comprehensive income attributable to the parent at the year end. They are just asking about the parent. So that is what I need to calculate for the parent plus the subsidiary. So let's see what's there. At acquisition date, let's again prepare our working note to number 2. At acquisition date and at reporting date, what was my revaluation surplus? So my subsidiary's revaluation surplus at acquisition date was 2 million. That means 2,000. What was it at reporting date? Is it given to me? Is it given to me? What was my reporting date subsidiary's revaluation surplus? Where is it given? Read the question again. Come on. Read this. What is given to you? Read this. The fair value of subsidiaries' net assets are equal to their carrying amount with exception to the property which had a fair value of 800. And then in the end they've given both have revalued their assets. Parents' assets have increased by 2 million and subsidiaries' assets have increased by 5 lakh. So they have given me the post-acquisition movement that after acquisition, subsidiaries' total revaluation which has happened is 5 lakh. So how much share will parent have in it? What is 5 lakhs 80%? What is 5 lakhs 80%? 400. Very good. And what was parent's revaluation? surplus during the year, because they are asking you what goes into OCI. OCI has only the income for the year. This year, what was your gain? OCI does not have previous year's revaluation surplus. That's a reserve which is there in the balance sheet. So they are asking you this year's gain. And in this paragraph, they have specifically mentioned that the parents' gain during the year was 2000, that is 2 million. So how much is my revaluation or OCI? OCI income for the year 2400. Yes. So can you see 2400 anywhere? So this is a fill in the blank. So you can simply write here 2400. I'm working in thousand. So 2000 related to parent, 400 related to subsidiary. Right? 2000 was related to the parent, this year's gain, because in the question they've clearly written that parent made a gain of 2 million and subsidiary made a total gain of 500. Parent will only have 80% share in that 5 lakh. That's why I said we only have 400 with us. 2000 was of the parent. So 2000 plus 400 is 2400. Do we guys understand this? Yes. Do we guys understand what's going into OCI? Everyone, come on, chat box. Are we clear on this? Why we didn't take 800? Which 800? Okay, wait. Let me re-explain. What's given in the question? They are asking you what goes into other comprehensive income of group this year. So in other comprehensive income, only the income for the year will go. We all agree with this? We will not take any reserve. We will only take the movement. So what affects my OCI? Revaluation surplus affects my OCI. When I made that working note number 2, I told you that 800 was added in both the columns, which literally gave you 0 post-acquisition movement. That's why it's not impacting my calculation. So I'm just looking at the post-acquisition part. So in the last paragraph, they have clearly given that during the year, that means this year, parent made a revaluation gain of 2000, that is 2 million, and subsidiary made total revaluation gain of 5 lakh, right? That is 500. So parent will not have 100% share in this gain of the subsidiary. Parent will only have 80% share. So that's why what I did 80% of 500, which came out to be 400. So I said total gain, parents gain 2000, subsidiaries gain 400. So total revaluation gain or total income in OCI is 2400. Do we understand it better now? Everyone? Good to go? Yes? Awesome. Next. Identify whether or not the following items should be recognized as assets in the consolidated financial statements of the parent. You will tell me. Subsidiary's brand name which was internally generated, not shown in subsidiary's financial statement, but has a fair value of 3 million. Internally generated brand. Upon consolidation, do I record it or not? Vanessa says no. Many people say yes. Come on, everyone has to try. Don't be hesitating. Yes, no. The reason I picked up with this question was this part of this question. We do recognize it. Very good. So the students who studied from me, they know it's a danger item. It's a danger item. Why is it a danger item? Upon consolidation, when you acquire a subsidiary, let me explain this to you. When I acquire a subsidiary, I am getting into a long-term partnership with this company. I'm going to be with this company forever. I don't have a plan to sell this company. Now, if this company has any court case going against it, court cases based upon probability, if there are possible chances that you will lose a court case, what do you create under IAS 37? If there are possible chances that you might lose court case for the expenses, what do you disclose? Possible chances. Listen to the question carefully. There are possible chances of losing the court case. What do I disclose? Contingent liability, right? Contingent liabilities are disclosed in notes to accounts. They are not even recorded because we think the chances are less, no? So what if we do not have any loss because of, this contingent liability? So we just disclose that. Now, if I have a contingent liability being disclosed by a subsidiary, imagine you are planning to buy a company and there's a court case going on that company. Will you not consider what if this subsidiary loses the case? If it loses the case, I will be bearing the cost, no? Because I'll become the parent. I'll become the whole king of this group. So I will be bearing that cost. When you guys think about matchmaking also, you do consider so many things 360-degree. So when you buy a company, will you not consider this? You will consider, no? So that is why upon consolidation, we record contingent liabilities of the subsidiary in the goodwill calculation. It's just like you guys watch Shark Tank. Do we watch Shark Tank? Anyone who's watched Shark Tank here? I think it's very much relevant these days. We're watching it. So what's happening in Shark Tank? So you guys negotiate, no? You guys talk with that investor talks with the investee that, this is good things. These are the good things I have. Yesterday I was looking at a clip and that girl said, I have a good credit rating. Please give me debt. So that means they were negotiating. They were telling their good points. So when you tell your good points to the investor, so in that case, you will also talk about your brand. Won't you talk about it? Even though it is internally generated, you'll be like, I have a brand. I have a goodwill in the market and that's fair value is 3 million. However, in the financial statements, I've not recorded it because the standard does not allow me. IAS 38 does not allow me, but still I have a brand value. So you will boast about your brand. It's your USP. It's something you're proud of. So you will talk about it when that merger and acquisition will happen. So that means some things which are not recorded in our individual financial statements are recorded in our consolidated financial statements because of the negotiation happening. Similarly, if you are, as I want to raise finance, so to the investor, I'm saying I have a brand. So maybe if you talk about TG Profs, let's suppose I say I have a brand in ACCA community, I have a name. So, I have not recognized it in my financial statements, but I do have. So when I will be talking with the investor, I'll put this point across. Yes. Now the investor might come up and tell me that you also have a case going on you. Even though I would say, no, the chances are possible only. But he's like, no, you have a case going against you. What if 1% chance you lose that case? I'll bear the cost. So on negotiation, when we sit on the table and we negotiate with the investor, when we are raising finance or when we are doing this merger and acquisition, the contingent liabilities which were never recorded in individual accounts are recorded in consolidated account. Danger item number 1. Similarly, internally generated brands which are never recorded in individual accounts are recorded in consolidated accounts. Yes. So individual account says ignore if the chances of losing the court case are less. But the investor says, what if you lose? I too will record it. Because I am putting my money on you. Do we understand this? The logic behind why we recognize internally generated brands? Do we all understand the logic? Come on quickly, chat box. Yes. Do we understand it? So from today onwards, you will not forget that there are 2 danger items on consolidation. Danger item number 1, quickly. Danger item number 1. Internally generated brand. Danger item number 2. Danger item number 2. Contingent liability. Awesome. Okay. Let's see. A research project is in progress, which was one of the main reasons parent purchased the subsidiary and has a fair value of 2 million. So do you think I should be recording this? I purchased this company because of this research project. So should I be disclosing it? Should I be including this? Yes or no? Yes. Yes. Okay. Ashish, please refer to the recording. We have limited time. So we need to repeat again one thing I can't cater to. If you have a specific doubt, you can ask. Then what do we have? An intangible asset related to an encryption process which has now been deemed illegal. This is included within intangible as 1.5 million. Encryption process. Encryption might be a process. We are not UPSC aspirants. We don't know everything about what is encryption, what is this, what is that. We are just having a basic common sense that encryption is a process which is now illegal. So that means now we cannot do this process because it is illegal. So should I record any intangible for this? No. So we will not include any intangible for this. So that's it. Let's move on. Parent has also owned 30% of Anderson. 30% means which kind of relationship is this? Which kind of relationship is this? Associate. Very good. So I will talk about which standard then. What standard applies to an associate? What standard applies to an associate? IS 28, equity method of accounting, single line accounting. So I'll talk about IS 28. So I have owned 30% of associate for many years and I use equity accounting to account for the investment. I use equity method of accounting under IS 28. During the year, parent sold 3 million of goods to associate at a markup of 20%. And quarter means 1/4. So 1/4 of these goods are still there in the inventory of the associate. So this is an intra-group sale between parent and associate where parent is selling goods to the associate. So first tell me, what's the journal entry? When parent sells goods to the associate, how do you derecognize the PURP? Parent has recorded the profit, extra profit, because this is intra-group. So if today I sell something to my brother, my mom would say this is intra-group, this is within the family. I sell something to my friend, that is also intra-group, that is within the family. So you do not record gains and losses on them unless that particular product, that particular service has gone out of the family. That means it has been sold to a third party. So that means parent sold 100 goods to A. A still has 1/4 of it in its inventory. That means 3/4 were sold to third party. So I will only calculate 1/4 of PURP. So what is my journal entry? Come on, tell me what's the journal entry when parent is the seller? Parent has recorded the profit. Overstated profit is of the parent. What has associate recorded? What has associate recorded? Associate has recorded overstated inventory. Do I record associates inventory in my group of financial statements? Do I record associates inventory in my group financial statements? No. I just show in my balance sheet with regards to my associate, I just show cost of investment in associate, right? That's the only thing I have in my balance sheet with regards to associate. So what is my journal entry to remove the profit? group retained earnings debit to remove the profit of the parent. And to reduce the inventory of associate, I can only impact the cost of investment in associate. So I can reduce my cost of investment in associate. So this is the journal entry that you pass when the parent is selling good to the associate. That's the concept that we've revised. Now we need to calculate our PURP. How we will calculate our PURP? What's our intragroup sale amount? Intragroup sale amount is 3,000. What's our markup? It's 20%. Markup is on cost or on selling price? Markup is on cost or selling price? Cost. So cost is not given to me. Selling price is given. So selling price is equal to $3,000. If I apply my logic, I would say my cost, let the cost be X. So X plus 20% of X is equal to 3,000, right? That means cost plus profit is equal to selling price. That's the equation. So I would say it is 1.2x is equal to 3,000. So what's my cost? 3,000 divided by 1.2. So what's my cost? Yes. What's the cost coming out? 2,500. Very good. So the cost is $2,500. What's my profit then? What's my profit? 500 is the profit. But what's your PURP? Only 1/4. So what's the 1/4 of 500? What's the 1/4? 125. So seems to be my answer must be what? 125? Or is there anything which is left? Will I remove the full profit or will I remove only my share of profit? In associate, would you remove the full profit or just your share of profit? Only your share of profit. So what you got, this 125, multiply this with 30% because that is only intragroup. You do not consolidate parent and associate at 100%. You do not consolidate the full parent and the associate at 100%. You just show 30% under equity method. So how much is this coming out? 37,500. So my answer is 37,500, which is option B. So one learning point for today. When it is a sale between parent and subsidiary, I don't do this last step, which I just did 30% thing. But when it is a sale between parent and associate, I need to do this. This is one learning thing that you have achieved today. Are we all clear? Let's move on to the last question, 380. Okay. Next. Fine. On 31st December, parent disposed its entire shareholding of subsidiary for 9 million. At this date, the remaining goodwill was 1 million, the fair value of NCI was 2.5 million, and the fair value of net asset was 10.6. So they are asking me, what is the profit or loss on disposal of subsidiary to be shown in consolidated financial statements? So when you dispose your subsidiary, first of all, you need to understand that whenever I dispose my subsidiary, there are two types of profits which arise. A profit which will be recorded in individual parents account, then a profit which will be reported in group accounts. These are the two types of profits which are arising. In the individual accounts, how will you calculate the profit? You will simply say proceeds minus the cost of investment. That's how I will calculate my profit or loss on disposal of the subsidiary. But when I talk about group accounts, when you dispose a subsidiary, you should stop the consolidation. Yes, I should stop the consolidation process if I have disposed a subsidiary, right? So that means I need to calculate the total profit or loss which has happened to the group because of the disposal of subsidiary. Now it's a very interesting formula that I'm going to teach you. This is known as happy sad formula. You will tell me at the net, will you be happy or will you be sad? When you receive money to, after the disposal of subsidiary, when you receive money, are you happy or are you sad? If I today credit your bank account, will you be happy or will you be sad? Happy? Yes. So proceeds added. Whatever you receive is something you are happy about. Now, that NCI subsidiary, whenever I purchase a subsidiary, there's always a non-controlling interest. Now, this non-controlling interest is just like your sibling who's always asking for your, if you have ordered a pizza, they'll ask their share. So NCI is always asking shares in profit. So if NCI would be gone, will you be happy or will you be sad? NCI gone because I disposed the subsidiary. Will I be happy or sad? Happy, not sad. I'll be happy because NCI has a credit balance. If it will go, I'll be happy. So NCI at disposal date. Whatever was the disposal date. Now, since subsidiary is being, disposed, will you be happy or sad about the net assets which subsidiary is taking along with it? Sad. So net assets of subsidiary at disposal date. So that is deducted. Similarly, about the goodwill, will you be happy or sad? Goodwill is a good thing. Goodwill. Now goodwill is also going away. That subsidiary is going away. So sad about the goodwill. So deducted. Goodwill at disposal date. So now tell me, this is the formula that we've made. Is it something we need to cram? Is it something which we need to cram for our exam? Can you apply this formula to this question? Let's quickly apply this formula to the question now. What's happening here? What is my proceed? My proceed is given to me in the question as 9 million, which is 9,000. What's my NCI on disposal date? My NCI on disposal date is given to me as 2.5 million. So that is 2,500. So I'm happy about losing it. Then my net assets of the subsidiary at disposal date are given to me as 10.6. So I am sad about losing them. So I'll deduct it 10,600. My goodwill at disposal date. What's my goodwill at disposal date? Let's apply our Dora's Explorer brain. Here it is 1 million. So 1 million. I'm sad about it. Tell me total profit or total loss? And what's the amount? Do the calculation, quick calculation. Total profit or total loss? Hundred loss. Very good. So there's a loss of 100. So let's see if that option is available. Yes. Option is A. Loss on disposal 1 lakh. Are we all clear on this? Goodwill should be deducted, not added. It should be deducted. So 100 is my answer. Are we all clear? Come on, quick confirmation. Yes. So consolidation, one MCQ, like one full concept covered. So basically through MCQs, I have tried my level best that I could have explained you the concept along as well so that you remember it in your exam. Let's move on. Let's move to our next important MCQ, which I have circled for you. Okay, here we come. 351 onwards. Okay, so what are they asking me over here? Let's read it together. First of all, they are saying which of the following is correct regarding Promoil Company's proposed accounting treatment? What is this Promoil Company? Let's read it out. Let's have a background. So Promoil financial statements for the year ended 30 September were authorized for issue by its director on 6 November, and the annual general meeting will be held on 6 December. So my issue authorized for issue is on 6th November and general meeting is 6th December. So authorized for issue means that you are about to publish it in annual general meeting. It is actually published. So on 1st October, Promoil acquired an oil platform at a cost of 30 million. What's your year end first of all? Is your year end given to you here? Is there any year end given? Can you find year end anywhere? Okay, let's read it. So on 1st October, oil platform at a cost of 30 million was purchased, and the estimated cost of removing this platform at the end of the life of the asset on this date will be 15 million. So this is nothing but dismantling cost under IS 16, which you capitalize. This is dismantling cost which is capitalized. The present value is to be calculated of this 15 million. So you will calculate it. How many years are there from 1st October 2017 to 30 September 2027? How many years are there? There's a difference of a decade. There's a difference of a decade. 10 years are there. So I need to calculate the present value over here. Come on, calculate the present value of 15 million. Discounting factor, cost of capital is given to you 8%. For 10 years, annuity factor is 0.46. Multiply 15 with 0.46. 6,900. Very good. So my present value to be capitalized is 6,900. Awesome. Let's move on. On 12 October 2008, next year, a fire destroyed Promoil's largest warehouse. The carrying amount of the warehouse was 10 million. Promoil expects to be able to recover this much from its insurers, and its going concern is not in doubt. So what is the question basically? They are saying there is no legal obligation for Promoil to remove the oil platform. But Promoil has a published environmental policy which it has a history of honoring. So what should I do for this? If I do not have any legal obligation to dismantle my factory, but I have a constructive obligation. What is a constructive obligation? See, do I have any legal obligation for this marathon? You guys have not registered with me. You guys have not been part of my paid group. So this is not something which is legal on me. However, if the students who have paid for it, they would be like, no, ma'am, you're supposed to provide the services. We've paid for it. But the other students cannot say this. But I have a constructive obligation. Obligation is not always legal by law. It's also constructive. Constructive means that you have been saying this on your website. You've been saying this in your marketing. Or if you've been saying this, maybe not saying this, but you've been doing this as a practice. So that is constructive obligation. So what's my answer to this? B. Promoil should recognize a provision as there is a constructive obligation. Done. Next. If Promoil makes the provision, what liability will be shown in its statement of financial position at the year end 30 September? So on 1st October, guys, you calculated the present value to be 6,900. They are asking you 1 year later. So you need to unwind the interest because who's the sibling of present value? Unwinding of interest. So what will be my unwinding of interest? I'll say my total provision at the end will be 6,900 plus 8% of 6,900. Can you tell me how much is that? What is 6,900 plus 8% of 6,900? 7,452. Very good. So it is total is going to come out to be 7,452. So that is my closing provision. Next, Select the correct category for the events listed below as per IS 10, whether it's an adjusting event or is it a non-adjusting event. So if there would be a fire after reporting date, what's the reporting date? 30 September, and they're saying there might be a fire on 12th of October. There is a fire on 12th of October. Is it adjusting? Are you that Baba who knows everything that there is going to be a fire? So you never knew this, right? So this is non-adjusting. There was no such condition which existed at the reporting date that there might be a fire. So non-adjusting event. Then sale of inventory. What are they saying about inventory? They are saying that the single class of inventory held at another warehouse was valued at its cost and was sold for this much on 10th October. So as per IS2, at what amount do I measure my inventory? Lower of cost and NRV? Lower of cost and NRV. And that's your duty to estimate what would be the NRV and what would be the cost and take lower of it. So you never estimated it correctly at the reporting date of 30 September. And you got to know on 10th of October that you sold your inventory for 2,80,000. Which means this is your mistake. The condition existed at the reporting date and you did not estimate it. So that's why it's an adjusting event. So this is adjusting. Right? Now, if I just tell you about guesswork, let's suppose in the exam you were totally blank, whether it's adjusting or non-adjusting, just a commonsensical guesswork that I'm telling. One, you have estimated that this is non-adjusting. So what is the chance? If they have only given us two options, the other would be adjusting only. There's very less chance that it would be non-adjusting. And the examiner has given you both the situations for non-adjusting only. So there are very less likely chances. So that's how you apply your educated guess. Right? So if let's suppose you are not able to figure this out in the exam, you have to make your educated guess. Next, on 18th November, once again after the reporting date, the government announced tax changes which have the effect of increasing Promoil's deferred tax liability by 6,50,000. Government changed the rules. Government only changed the rules. What do you think? Is this something, what they're asking, which of the following is correct? This is a non-adjusting event and no disclosure required. This is an adjusting event. This is neither an adjusting nor an non-adjusting event. This is an adjusting event and the financial statement should be reissued. Tell me. What do you think? Yes, Yashika, it will be disclosed only. Why C? Why neither adjusting nor non-adjusting? See, if your deferred tax liability will change, you change it in the next year, no? It's not impacting your last year's anything. This will happen next year, so we will show the movement in the next year's. This is not impacting at all. Like this is neither adjusting. This is nor non-adjusting. This is neither adjusting nor non-adjusting. This is nothing. Because this particular deferred tax liability only never existed at the year end. That means this existed at year end, 6,50,000 was there at the year end. But if the government tax changes, that tax change or that tax rate is not something which we are explicitly using, right? So this is not, this announcement happened. This announcement happened at like 18th November 2018, which is not something which we consider. Why do we not consider it? Another reason for not considering it is in front of you. You have issued the financial statements. Another major issue is that your financial statements were issued by 6th of November and this is happening on 18th of November. So once the financial statement has been issued, they become something that you don't account for. Now the thing has gone. You can't reissue the things. There's no point of reissuing. So we do not consider the events which happen after the authorization for issue of financial statements. We only consider that, let's suppose my year end is 30 September and I am supposed to issue my report by November. So I will just consider what happens after this. It's something which can be termed as event after reporting date. What happens after this is not within the scope of IS10. So this is neither adjusting nor non-adjusting. Do we understand this? A new concept maybe for all of you. So it seemed to be non-adjusting event because the deferred tax liability change is something which we deal at the current year. No condition existed at the reporting date. But new learning point for us is that we just consider the reporting date time and the issue time. The period between these two dates is what I consider as event after reporting date. Are we all clear on this? May I move on? Are we all clear on this? Yes or no? Yes. Okay, next. How should this be treated in the financial statements of Promoil? What should be treated? You will tell me this, okay? Promoil owns the whole of equity share capital of its subsidiary Hamlet, and Hamlet's statement of financial position includes a loan of 25 million that is repayable in 5 years. So there's a loan which is repayable in 5 years. 15 million of this loan is secured on property. That means, if you guys understand Hindi, this is like secured loan means girvi. You've kept something as a security. So this loan is secured on property, and the remaining 10 million is guaranteed by Promoil in the event of a default by Hamlet. It is possible that Hamlet will be unable to repay the loan, but not likely. So this whole thing is not important for us. The last line is important for us. They are saying you will be unable to repay the loan, but not likely. So what should you create? Because if you do not repay the loan, there will be some penalty on you. You will lose your property which you kept as security. Will you disclose a contingent liability, create a provision, do nothing, or reduce your PP? Very good. Contingent liability. So when I have to disclose, I have to disclose a contingent liability, right? That's it. So we are done with 10 of our MCQs. Let's move on. Let's see what's next. So these are all single entity concepts. See this question. No need to do these ones. 341 to 345. If you guys are watching my YouTube channel, I'll be uploading it there. So keep track of it. 341 to 345. Then let's see what's next. Okay. Another case study. Let's do it. Question number 326. Everyone, calculators out once again. This is a calculation based question where they'll ask you to prepare P&L and stuff. So profits are to be calculated. So what's the first requirement? What gain or loss should be recorded in the statement of profit or loss for the year ended 31st December 2001 in relation to the payable recorded for the purchase of goods? So there is a payable that I have recorded since I have purchased some goods, but that is in foreign currency. So which standard applies to foreign currency? Come on quick. Which standard applies to foreign currency? Let's test your knowledge. Which standard applies to foreign currency? IS 21, foreign exchange rate. So what is there in IS 21, guys? What's there? We divide the items into monetary and non-monetary. Monetary items are converted at closing rate and non-monetary items are kept at historic rate. So on monetary items, we get an exchange difference. From which statement do we take that exchange difference from? From which statement do we take that exchange difference from? Very good. Statement of profit and loss. So we take it from statement of profit and loss. On this, we will never have any exchange difference because this is kept at the same rate. You don't change the rate over here. So let us read this question. They are asking us for payables. So we have purchased Vanis buys and sells goods in Cromage but has a functional currency of dollar. Venice purchased goods for Cromit 10,000 on 1st September. At Venice year end of 31st December, this amount remains unpaid. So when you purchase goods, you've not yet paid for it. So on 1st September, first you will use spot rate. What's the spot rate? 1st September rate is $1 is equal to 10 Cromits. So how much will be 10,000 Cromits be equal to? How do you do this calculation? Let me show you. So my question says $1 is equal to 10 Cromits. That means 1 Cromit is equal to 1 by $10. If I want to calculate 10,000 Cromits, multiply both sides with 10,000. So in dollar, it would be 10,000 divided by 10. How much is that? $1,000. So in dollars, what's the amount? On 1st September 2001, my amount is $1,000 of my payable. But at the reporting date, it is still unpaid. So what's your reporting date in the question? The reporting date is 31st December. So you will take this at its closing rate now. What is the closing rate? $1 is equal to 8 Cromits. So at the reporting date, 31st December 2001, now your payable will be reported at 10,000 Cromits divided by 8. Can you tell me how much is that? 10,000 divided by 8. How much is that? 1250. Thank you, Ria. So this is $1250. Payable has increased from 1,000 to 1250. It's a gain or a loss? Loss of 250. So what's my loss to be reported? C is my answer. Loss of $250. Awesome. Done. Next. What gain or loss should be recorded in the statement of profit or loss for the year ended in relation of sale of goods? So we have some sales that we've made. Now in 1st September, we've made a sale of 60,000 Cromits. On 1st October, we received 30,000 Cromits. The remaining 30,000 is unpaid. So what is your closing date receivable? What's your closing date receivable? Total sales you made were of 60,000. Out of that, you've received 30,000. So what's your closing date receivable? Closing date receivable is 30,000 Cromits. Yes. So I need to calculate my foreign exchange gain or loss on this because it's a monetary item. So I will say, okay, this 30,000 on the date of 1st September 2001. What was my exchange rate? My exchange rate was $1 is equal to 10 Cromits. So I will say it was 30,000 divided by 10, which is $3,000. This is Cromits, 3,000. But at the reporting date, now I will use the closing. So it will be 30,000 divided by 8. Can you tell me how much is that? My closing receivable is, what's my closing receivable? 3750. 3750. Right. So this is 3750. So as per this, you are making a gain or a loss? On the receivable, you're making a gain or a loss? Gain. There's a gain of $750. Now in the question, if you check, the requirement says that calculate the total gain or loss in relation to sale of goods. So for the receivable, we've calculated that our gain would be 750. But there was other sale also. What was my other sale for which I've received the cash? So once again, I made the sale on 1st September and the sale was of $3,000. But I received cash. Cash you will always receive at spot rate, the rate of that date. So when did you receive cash? You received the cash as per the question. We received 30,000 cromets on 1st October. So what was the exchange rate? 10.5. So how much cash have you received? You've received a cash of 30,000 cromets divided by 10.5. How much? How much cash have you received? $2,857. So you were expecting $3,000, but the customer paid this much. What's that for you? You were expecting $3,000, but the customer paid a cash of 2,857. What's that for you? Loss of 143. So this leads to a loss of 143. So on the cash receipt, I have a loss of 143. And on the receivable, I have a gain of 750. So what's my net gain? My net gain is 750 minus 143. Can you tell me how much is that? 750 minus 143? 607. Can we find 607? Yes. Option B. So 607, option B is my answer. Clear? Let's move on. So there were two gains here because I read the question carefully. See, if you were not reading the question carefully, you might have missed this. You might have missed this, that they're asking for the total sale of goods. Profit or loss for total sale of goods is what they've asked. You might have just thought about the receivable. So what did you learn from this question? Reading the requirement is very important because we need to understand that what they are asking. But however, this question was good because even if you were getting just a gain of 750, there was no option for this. So that's quite a liberal question in that way, because if you don't find your answer in the options, then of course you will rethink. But if they give 750 in the options, you could have stopped your answer there. So always give a double thought of whatever you are doing. Okay. Next. Which of the statement are true? Statement 1. Inventory is purchased on 1st October and should be retranslated at closing rate if the goods remain in inventory at 31st December. Is inventory a monetary item? Is inventory a monetary item? Can you sell inventory whenever you want? What is monetary item? Anything which you can convert into cash as in when you want it. So can you convert your inventory into cash? If today I have lectures in my inventory, when I want to sell it, can I sell it? No. So it will take time, right? It depends on the market. So that means it's a non-monetary item. It's not readily convertible into cash. Therefore, my answer is false. Statement 2. Foreign exchange gains will be added to the revenue for the year. Is this right? False. This is also false because this goes into gains. Revenue is from the normal course of business as per IFRS 15. Okay. What will be recorded as tax expense in the statement of profit and loss? So now there is something related to taxation in this question as well. So let us read. They're asking the tax expense to be reported in P&L. Vanice's assistant accountant estimated the tax expense for the year end of 31st December at $43,000. So my this year's tax expense was 43,000. However, he had ignored deferred tax, which is wrong. So at 1st January, that is the beginning of the year, our deferred tax liability was of 1,30,000 and our taxable temporary differences were of 3,60,000. Our tax rate is 25%. So what is my opening deferred tax liability? Opening deferred tax liability is 1,30,000. So just write it here. Opening DTL is 1,30,000. How much do I need at my closing date? In the closing, I need, what were my taxable temporary differences? 3,60,000. What was my tax rate? 25%. So how much closing deferred tax liability do I want? Come on quickly, calculators. 3,60,000 into 25%. 90,000. So basically I want how much? 90,000. So my DTL is reducing. What's the movement? It is reducing by, calculate the balancing figure. It's reducing by how much? $40,000. Very good. So this is reducing by 40,000. So that's the movement which is going to go in my statement of profit and loss. So how much tax expense will be shown? This year's tax expenses 43. There is a income on taxation. There is a positive, you can say, if your DTL reduces, that's your income, right? What's your journal entry? DTL debit, income credit. So expense of taxation was 43,000 and there is an income of 40,000. So what's the net expense? Net tax expenses 3,000. So let's see if it is available. Okay, it's fill in the blank. So my answer is $3,000. 3,000. That's my tax expense, net tax expense. Are we clear on this? Are we all clear on this? Yes? All clear? Okay. Next. Now the accountant has discovered, this accountant keeps on discovering new and new things. He's discovered that there is a debit balance on the trial balance of $3,000 relating to the over or under provision of the tax from prior year. Debit balance is under provision or over provision? Under provision means last year, whatever you estimated for your taxation was less. So this time you're going to provide for it. So that increases your expense. That means last year you recorded less expense. That's why we call it as under provision. So under provision always have a debit balance, right? And over provision always have a credit balance. So in this case, it's a debit balance. So it's an under provision. So what should be my answer? Increase the tax liability by 3,000 in the statement of financial position. Decrease the tax liability by 3,000. Increase the tax expense by 3,000. Decrease the tax expense by 3,000. What should be the answer? Under provision means the expense recorded in the last year was less, so you need to record that expense today. So what is my answer? C. Very good. I need to provide an expense. So my answer is C. Done. Are we all clear on this? It is the expense now, right? Are we all clear on this? Whole question? So see, we've revised IAS 21 via this question. We've revised our deferred tax via this question. So that's a wholesome question. Let's move on. Let's see something on revenue or financial instruments now. Yeah. IFRS 9. Come on, let's do this. Question number 311. Question number 311, everyone. Kaplan kit. So if you want this question on your end also, however, I would recommend that you don't open it on your end because you anyway have it on your screen. So let us do. Why it will not affect the liability? Okay, Ashish, you're asking about the previous question, why it will not affect the liability? Because closing liability is like already given to us. Closing liability in the question is usually given. It impacts first our P&L. Under provision, first impacts our P&L and then it impacts the balance sheet. First you prepare the P&L, right? And then the balance sheet. So yes, it would impact the closing liability of the taxation, but first it would impact P&L. So in that question, they didn't give me an option where they write it will increase the liability and the P&L expense both. That's why I first chose for P&L. Right? Okay. First question. Which of the items included in the trial balance extract will be classified as financial instruments? You only tell me which will be classified. Are convertible loan notes financial instruments? Have you done convertible loan note? Is it a financial instrument? Yes. So it's a financial instrument. Loan note and equity investments, are they financial instruments? Yes. Convertible loan note and debentures, are they financial instruments? Yes. So all the three items are financial instruments. So my answer is option D. Correct? Next, they're asking what should be the value of the liability element of convertible loan note at 30 September to the nearest thousand. So let's quickly revise convertible loan note under IFRS 9. So convertible loan note, how do we do its accounting? When you issue any convertible loan note, that means the counterparty might choose to get payment in cash for the principal and the interest, or they might convert their loan into shares. So you do split accounting. Split accounting is what we follow. We split it between liability component and equity component. Liability component and equity component. So the liability component, how do you calculate it? What's the rule? Theoretical rule. The liability component is calculated as present value of future cash flows, present value of future cash flows which are discounted. What is the discounting factor for it? The discounting factor is interest rate on, come on, you tell me, effective interest rate or there's a separate interest rate? Let's test your memory. Which interest rate do you use? Arshad says effective, Vanessa says effective, Nisha says effective. Separate interest, effective interest, Ashish says effective. Effective. All are short-term memory loss. So watch Ghajini. All are Ghajnis. What do you use? Interest rate of similar bond. No. Similar bond without conversion option. I use the coupon rate of such a debenture where there is no conversion option because I am just calculating liability portion. I am assuming that all my loan note holders will take cash only. They will not convert it into shares. So what do I use? I use the coupon rate, not the market rate. Coupon rate of similar bonds without conversion option. The bonds, the loan notes which are of similar nature, but they do not have convertibility option within themselves. So I take the interest rate of those loan notes. Do you guys understand this? Do you guys understand this? Do we remember this from our studies? Very important star point. Please write it somewhere because this is something which you are forgetting. Very confidently, we were saying effective interest rate. See, effective interest rate is used everywhere. Only there are few exceptions. One exception is convertible loan note. Another exception is leases. In leases, you use the rate implicit in the lease or incremental borrowing rate. So you can write it somewhere. Which rate are you using where? Come on, let's make a short note. Whenever we have any financial asset, we have any financial liability, we use effective interest rate. Whenever we are following especially the amortized cost method, we use effective interest rate. If nothing is given, we use effective interest rate. But in convertible loan note, it's different. What do you use in convertible loan note? You use the rate of similar bonds without conversion option. Yes. And what do you do for leases? IFRS 16, you use the rate given in the lease, implicit in the lease. Lease has a contract, there's a rent agreement. So this is written in the lease. Then if that is not available, we use incremental borrowing rate. What is incremental borrowing rate? That what if the asset that I've taken on rent, if today I buy that asset and for that I take a loan, how much interest I will pay on that loan? So I use incremental borrowing rate. Please write it somewhere quickly. I'm giving you 2 minutes. Quickly write it somewhere and let me know in the chat box once written. Done. Awesome. Okay. Now let's apply this over here. So here they're calculating liability element, right? So we need present value of future cash flows, which we will discount using the rate that I told you. So we are given that there is a convertible loan note. On the opening date, the liability component is this. So they've already calculated the liability component for us. So they are saying that the convertible loan note are 8%, $30 million convertible loan notes, which were issued on 1st October 2014 at par. An equivalent loan without the conversion option would carry an interest rate of 10%. So this is the rate that I'm supposed to use. Equivalent loan without conversion option would carry an interest rate of 10%. And the finance director correctly split the instrument into its equity and liability component, but has not done nothing else. So basically, the subsequent treatment of this liability is not done. What's the subsequent treatment of a financial liability? How do you treat it? What's the subsequent treatment of financial liability? Amortized cost. How your amortized cost table is made? Amortized cost table is opening liability plus interest minus cash paid. Cash is paid on coupon rate, gives us closing liability. So opening liability as per the split accounting which they've already done is 28508. So I'll say opening liability is 28508. Interest rate, which interest rate will I use? I will use 10%. That's the rate of similar loan note without conversion. So what is 10% of this? Yes, 10% is 2851 approximately. How much cash am I receiving? I'm receiving cash at coupon rate. Sorry, I'm paying cash at coupon rate. So what is the coupon rate? 8%. Should I do 8% of this or should I do 8% of this? How much cash are you paying? Cash payment is a fact. So factually, how much cash are you paying? On your estimate of financial liability, you pay the cash, or on the nominal value, you pay the cash. 8%, 30 million debenture. So am I paying cash on 30 million or am I paying cash on 28508? 30 million. Very good. We always pay it on nominal value. One more clarity you just got. Cash is always paid on nominal value. So what is 8% of 30,000? Quick. What is 8% of 30,000? 2,400. So what's my closing liability? What's my closing liability? Option C. What's the closing liability coming out to be? This 28,508 plus this minus this. This is 8. So I'm sure you're getting option C as your answer. So my answer is option C. Awesome. Then what is my finance cost which I should show with respect to my loan note? So from this loan note, I should show 2851. But is there any other loan note also? Yes. There is another loan note, 5% loan note. It was issued at par for 10 million, but we incurred 4,000 as issue cost. This is the transaction cost. The loan note have an effective interest rate of 8%. This is a general loan note. It's not a convertible loan note. So how much finance cost you will have? First of all, will you capitalize transaction cost in this case? Will we capitalize transaction cost? Yes. Will I capitalize transaction cost? How do I capitalize transaction costs? See, IFRS 9 says initially all my financial instruments are recorded at fair value and the transaction cost is capitalized unless the method followed is fair value through profit and loss. So in financial liabilities, we all follow just amortized cost. That's what is there in your syllabus in FR. However, in SBR, you will study that in financial liability, you also have fair value through P&L method. But you follow amortized cost method. Correct? In financial liability, if I have to capitalize my transaction cost in liability, will I add it or will I deduct it? Capitalization in itself is a happy thing. Capitalization in itself is a happy process. Yes, it's a happy process. So if you want to capitalize your cost in financial liability, should you increase your liability or should you decrease your liability? When will you be happy? Yes, happy sad rule. Decrease. So I need to remove it from my liability. I'll remove it from my liability so that I get a happy outcome. So what will I do? My initial would be 10 million minus 4 lakh. What is 10 million minus 4 lakh? Basically, if I work in thousands, it would be 96,000. Sorry, 9,600. So initial value would be 9,600. My interest rate is how much? Effective interest rate in the second loan note is given as 8%. What is 8% of this? 768. So that's what they're asking me. They're asking me total finance cost. They're asking me total finance cost. So what would be my finance cost? 768 relates to this 5% loan note. So they've asked you finance cost to be shown in statement of profit and loss in respect of the loan notes. Now the question is, should I add this 2851 to this, or should I just talk about this 768 that we've calculated? Because they have not given us any clarity, no? Have they given you any clarity that what should go, for which they are asking, which loan note they are asking, loan note 1 or loan note 2, or they are asking combined? Have they given you any clarity over here? In question, it only tell about loan note 2. Where is it written? This is also loan note. This is also loan note. Then what to do? See how we will decode this. The convertible loan note they are mentioning is convertible. So they are referring to it as convertible loan note. And to this, they are just calling it as general loan note. Yes, they have just simply written loan note. So we will assume that they are just asking about the plain loan note, which is loan note number 2. So I will say my answer is just 768000. Because when they wanted me to answer about convertible loan note, they mentioned convertible loan note. Now they've just plainly written loan notes. So they're talking about the plain loan notes, not the convertible ones. So this is something that you have to apply as your brains in the exam. You might confuse that I will include this also, but that is not to be included. Okay. Next. What income should be recorded in P&L in relation to equity instruments? So is there any equity instrument also? Yes. My equity investments are given to me at the reporting date as 6,000. So my equity investments, this is the opening date, sorry. So equity investments relate to 1 million shares in Kapoor, an unrelated entity. During the year, Kapoor paid a dividend of 10 cents per year per share. So at 30 September, the fair value of each share was $7. So how many shares do you have in this question? How many shares do you have in Kapoor company? 1 million shares. How many shares do I have? 1 million shares. How much dividend am I receiving? I'm receiving 10 cents per share. 10 cents means $0.1. So I am receiving $0.1 per share. Multiply this with 1 million shares. 1 million shares means this much. How much do you get? What's your dividend income? What's your dividend income? 1 lakh. So 1 lakh is your dividend income. And then they are asking you that there is some fair value gain also. Under IFRS 9, if nothing is given for my equity instruments, under which method do I keep it? If nothing is given with regards to my equity instruments, under which method do I keep it? For equity instruments, I have two methods, fair value through P&L and fair value through OCI. If nothing is given, by default method is fair value through profit and loss. So my reporting date, what I thought was the value was 6,000 versus now at the end it is 7,000 because the share price is 7. So what's the gain that I've made? I made a gain of 1 million on that. 1 million means I made a gain of 1 million. So gain on investment is $7. Reporting date is $7 into 1 million shares, which is 7 million. This was the value, and opening value was 6 into this, that was 6,000. So my gain is of 1,000. If I work in thousands, what's my total gain? 1,100 is my total gain to be reported. So 1100 is my total gain. So my answer is B. 1000 for the fair value movement, 100 for the dividend income. Are you guys clear on this? Yes. Are we all clear on this? 1100? All awake? Yes, are we awake? Understanding? Awesome. Okay. Let's move on. Question number 315. Howard is uncertain of how to treat professional fees. For which of the following investment should professional fees be capitalized as part of initial value of the asset? When you keep anything under fair value through OCI, do you capitalize the transaction cost? Yes. When I keep it under amortized cost, do I capitalize the transaction cost? Yes. When I keep it under fair value through P&L, do I capitalize the transaction cost? No, we do not. So this is not capitalized. Otherwise, it is capitalized almost everywhere. Okay, so we are done with this as well. IFRS 9, we've practiced. Let us move on now. How many questions have we done till now? Can you give me the count? Are you keeping a count of the questions done? Constructive obligation. How many questions have we done? 20. 30 more to go. Let's go. So now I think I've kept the question in section A only. Yep. Last question from section B related to IS 16. Let us do this quickly. Let's do this quickly. Come on. You need to be fresh. You're just few days before the exam. We need a lot of effort. The CA students, they study for 6 hours at a stretch as the revisions with their faculties. You guys are just here for 3 to 4 hours. Don't worry. In accordance with IS 16, what is the value of additions to the plant for Abena company for the year ended 30 June? So they are asking me IS 16 value of addition. Question number 251. Okay. Value of addition. So what is given to me? Abena company prepares financial statements for 30 June. During the year to 30 June, company spent 5,50,000 on the plant. The cost of the plant was this. So this is capitalized. It's a purchase price. Delivery to the site. Is this capitalized? Delivery to the site? Yes. It's directly attributable cost. Building alterations to accommodate the plant. Building alterations to accommodate the plant. Are they capitalized? Do you capitalize this? Yes, you do capitalize it. Cost of initial testing of new plant, you do capitalize it. Plant operator training cost, do I capitalize this? No. Because I do not control this, right? This is not controllable, so it is not capitalized. So how much is going to be my cost of addition? Add them all, 525 plus 3 plus 12 plus 2. How much is that? 542. So my answer is 542B. Next, which of the following is true in relation to the change in remaining useful life? Change in remaining useful life is an accounting estimate or it's in policy? It's an estimate under IS 8. When you change the life of any asset, it's an estimate. And when I change any estimate, it's dealt prospectively. I need to deal with it prospectively. So I'll deal with it in the current year and the future year. So what's my answer? It's a change in accounting estimate which should be dealt prospectively. Next, In accordance with IS 16, what is the depreciation charge for the fixture and fittings for Abena company? So depreciation, let us quickly see what are our fixture and fittings. Let us quickly have a look at it. Abena's fixture and fittings were purchased on 1st July, that is like few years ago, at a cost of 50,000. The directors have depreciated them on straight line basis and our useful life was 8 years and residual value was 5,000. Then this year, opening date, the director realized that the remaining useful life of the fixture is 5 years. There is no change to the estimated residual value. Now guys, can you tell me how many years have already passed from 2002 till 2004? How many years have already passed? 2 years have already passed. So what is my depreciation for the 2 years? Cost was 50,000. Residual value was given to us as 5,000. Life of the asset is given to us as 8 years. So what's my depreciation? Multiply this with 2. What's my total depreciation for 2 years? 11,250. 11,250 was my depreciation for 2 years. So what is my carrying amount on the opening date? 50,000 minus 11,250. 38,750. 38,750 carrying amount. And then they are saying you're revising the life. So revision happens on this amount. So need to calculate the annual depreciation now. What would be my annual depreciation? 38,750 minus residual value of 5,000 divided by remaining life 5 years. What's the annual depreciation for this year? 38,750 minus 5,000 divided by 5, 6,750. Awesome. So my answer is 6,750. Let's enlighten our Dora the Explorer. So where is 6,750? Option D. Yes. Next question. In accordance with IS 38, what is the correct accounting treatment of 25,000 costs which were incurred on the research project? So what is this research project? Let's read about it. Abena began with the research project with the aim of developing a new type of machine. If the research is successful, they will manufacture the machines and sell them to the customers as well as using them in their own production process. So what do we refer in IS 38? How do we bifurcate what is development and what is research? Pirate needs to be met. What is pirate? P stands for probable economic benefit in the future. I stands for we have an intention to use or sell that particular thing which we are developing. We have resources, we have the ability, we have technical feasibility, we can reliably measure it. So over here, what is met here? See, they are saying we will start the manufacturing. So we are having the ability and the intention. During the year, the cost of 25,000 incurred on conducting feasibility studies and some market research. And then during the year, a further 80,000 was incurred on constructing and testing a prototype. So this 25,000 of feasibility means till date, I'm not sure whether it will be successful or not. So I'm still in doubt. It's research. Feasibility is something that I'm still in doubt. So it's a research of 25,000. So what I will do, this should be written off to P&L. So they should be written off to profit and loss as expense because they are research. Feasibility studies, market research is a research expense. But then the next, how much have you incurred? You've incurred something which is true for the following, which moves to the production and testing stage. When you move to the production and testing stage, then that 80,000, will it become development? Yes, I've started production. That means my research was successful. So I found the ways out. So I am going to start my capitalization. Yes, I need to start with my capitalization. So which one of these do you think is the answer? Here they are saying it has moved to the development stage. If development criteria met, can choose to recognize 80,000 cost as intangible non-current asset. Okay. This is totally incorrect. It is not research. It has moved to development stage. If the criteria is met, Abena must recognize. Here they have written must recognize. Here they have written can choose. So which one do you think is the answer? If the pirate is met, do you have an option to choose? No. So my answer is C. Very right. Awesome. So first of all, congratulations to all of you who have reached till here. Okay, so you have been studying well. Let's move on. 25 questions done. Half of our work is done. Now we'll be moving to little easier topics and easier questions. Okay, one more question from section B. Let's do. It's related to IS 36. Which of the following assets belonging to Chestnut Company require an annual impairment review? What is annual impairment review? It's conducted whenever there's an indicator of impairment. So we are supposed to tell whether was there any indicator of impairment of the given assets or not. So let's see, was there any indicator of impairment or not? Let us see it. Yes. So the following issues relating to Chestnut Company NCA are outstanding. Factory. On 1st January, Chestnut Company's factory had a carrying amount of 5 million. It had a remaining useful life of 10 years. There was an impairment review of the factory and the recoverable amount was deemed to be 2.5. And Chestnut Company's factory had previously been revalued upwards. And then there's a credit balance of 1 million related to this factory. Okay, so they are asking you, for which assets do you want to conduct annual impairment review? Will you conduct an annual impairment review here? You only conduct annual impairment review for goodwill and infinite life intangible asset? Yes. So for our factories, property, plant and equipment, etc., we conduct the review only when there is an indicator. So what is my answer here? What should be my answer? What should be my answer here? Neither head office nor the machinery, because both of them are neither goodwill nor infinite life intangible asset. So my answer is D. Next, in accordance with IS 36, impairment of assets, what is the correct journal entry to reflect the depreciation and the impairment of Chestnut Company's factory for the year ended 31st December? So they are asking you the correct journal entry for the factory part. So for the factory, we are supposed to see what would be our journal entry. So there is a impairment which is happening. First, you need to calculate carrying amount of factory. What will be the carrying amount? It was 5 million. Remaining useful life is 10 years. And on the reporting date, you have actually calculated the recoverable amount. So what is the carrying amount at reporting date? It is 5 million minus depreciation. What is the depreciation life of the asset is 10 years. Remaining life is 10 years. So 5 divided by 10, that is 0.5. So I get my carrying amount as 4.5 million, right? Compare it with the recoverable amount. The recoverable amount is equal to 2.5. What is the impairment? Impairment is, what is the impairment? Difference between carrying amount and recoverable amount. What is the impairment? 2 million. But related to this, there was a surplus balance of 1 million. So first you take out the impairment from revaluation surplus and the remaining balance is taken via P&L. I hope everyone knows it. So tell me what would be the correct entry. My non-current asset will be credited by, yes. What would be my journal entry? See, there is during the year there's an impairment of 2 million, and we just calculated this year's depreciation was 2.5. So both of these needs to be accounted for. Yes. So I will credit my non-current asset by 2.5. My surplus, I just have 1 million surplus, so I will remove this surplus and the balancing will go via P. Are we clear? Our answer is option A. Because there's depreciation of 0.5 also, that is also not accounted for, so you need to account for that as well. So total loss is 2.5, 2 for impairment, 0.5 for the depreciation, and surplus will be debited by 1 million and the remaining will go via P&L. Are we guys clear on this? Come on, quick confirmation. Are we guys clear on this? Then only I'll move ahead. Yes. Okay. Next. What is the carrying amount of Chestnut Company's head office in the statement of financial position? So let's read the head office. For head office, we are given that Chestnut Company's head office cost was 12 million and it is being depreciated over a 40-year life. Head office cost is 12 million and it is being depreciated over 40 years. So what is your depreciation? Annual depreciation? 12 million divided by 40. Come on, quickly. What's my depreciation? Yes. 300 is my annual depreciation. That's good. Then on 31st December, there was an impairment review. So how many years have passed from January 2001 till 31st December 2004? How many years have passed? 1st January 2001 till 31st December 2004. 1, 2, 3, 4. 6 years or 4 years? 4 years. So 4 years have passed. Very good. So 4 years have passed. So how much depreciation has been charged? 300 into 4, which is 1200. So what's my carrying amount? My carrying amount is 12 million, which is 12,000 minus 1200. What's my carrying amount? 12,000 minus 1200. How much is that? 10800. Okay, so 10800. That's my carrying amount. Then they're saying an impairment review was conducted and the recoverable amount is 9 million. And a more recent valuation at 31st December has estimated that the recoverable amount would be 11 million. What are they doing? What are they doing? What I need to take into account? See, they are asking me in the question, what is the carrying amount on 31st December? So first of all, on 31st December 2004, I will conduct impairment. So my carrying amount on this date is 10800. My recoverable amount is 9,000. What is my impairment? What's the impairment coming out? This difference. What's the impairment loss in this year? 1800 is my impairment. From the next year onwards, that means now from the next year onwards, which is from 1st January 2005 till 31st December 2007, I will charge depreciation on 9,000. So what is the remaining life? What's the remaining life? Yes. What is the remaining life? What's the carrying amount on 31st December 2007? See, total life was 40 years. Out of 40 years, 4 years passed. Now after 4 years, how many years are more passed? 2 years more have passed. So total 6 years have passed. So what's the remaining life? Is this 2 year? Is this 2 years? The whole year of 2005, the whole year of 2006, the whole year of 2007. These are 3 years. So in total, 7 years have passed. So the remaining life is 33. So what would be my depreciation now? For these 3 years on 9,000, my depreciation would be divided by 33 with 3 years. How much is this? Yes, how much is this? 818. So what will be my carrying amount on 31st December? 9,000 minus 818. How much is that? 8182. Now they're saying that our value, our recoverable amount on the 31st December 2007 is given to us at 11 million. So now it has improved. So when it improves, it is going up to recoverable amount is coming out to be 11,000. So there's an improvement. This is known as reversal of impairment. This is known as reversal of impairment. How do you account for the reversal? How do you account for reversal of impairment? Reversal of impairment happens where you compare, you can only reverse the impairment up to the extent what would have been, please listen to it very carefully, what would have been the carrying amount if there was no impairment. So guys, if in 2004, if there was no impairment at all, if there was no impairment at all, yes, that means my carrying amount would have been this only. My depreciation, annual depreciation would have been same. Then what would have been my carrying amount? If my depreciation would have been same, what was my annual depreciation that I calculated? What was my annual depreciation? 12 million divided by 40 years. What was that annual depreciation? 300. So if my annual depreciation was 300 only, then my carrying amount on 31st December 2007, if there was no impairment, would have been how much? I need to calculate my depreciation for the whole years. 7 years have passed. 300 into 7. How much is that? 2100. My total depreciation would have been 2100. So 12,000 minus 2100. How much is that? How much is that? 1200 minus 12,000 minus 2100, 9,900. So I can only reverse my impairment up to the extent of 9,900. Yes. So I can only increase, or I can only reverse my impairment up to the extent of 9,900. So what should I do? What's my answer? What is the carrying amount of the head office in the statement of financial position? You can only reverse it up to the extent of 9,900. So answer is, can you see 9,900 here? Option B. So my answer is option B. Are we all clear on this? Are we all clear on this? 9,900. So this was a very important concept of reversal of impairment. Let us move on. Which of the following statements with regards to grants are correct? The deferred income method should always be used for grants related to assets. Is that correct? No, you have two methods. Under grants, you have two methods. So deferred income is one of them. Then grants related to income must be disclosed separately in the statement of profit and loss as other income. That's incorrect. There's nothing that which we've learned. The deferred income method should only be used if the grant is repayable. Grant relates to the assets can be accounted for either deferred income or by deducting it from capital. This is true. Correct. So my D option is the correct option. Right? Okay. Now, okay, one student is asking in the previous question, our fair value is 11 million. Why are we not recording it at 11 million? Because they're asking you the carrying amount. So yes, you will record it at 11 million. Right? You will record it at 11 million, but that's the fair value. The question is asking about carrying amount. Okay. You deducted from the assets carrying amount. That's correct. Last, what is the carrying amount of non-current liability in respect of government grant in Chestnut Company statement of financial position? No Ashish from the carrying amount always. What is the carrying amount of non-current liability in respect of the government grant? Yes. Let's see what's given to us with regards to government grant. On 1st April 2017, Chestnut Company received a grant of 2.6 million towards new production machinery. The machinery's cost was 4 million and it's expected to have a useful life of 5 years. Depreciation is charged on straight line proportionate basis. Chestnut uses the cost model when accounting for its head office and the deferred income method in relation to government grants. So we are supposed to use deferred income method. So they're asking you what would be the non-current liability part of it. So come on, try it yourself. Take 2 minutes, try it yourself. Yes. Have we tried? What are we going to do for this question? We have received a grant of 2.6 million. And when have you received it? 1st April. What is your year end? Your year end is 31st December. So how many months? How many months into the year? 9. So what will you do? We'll say the grant received is 2600. How much out of it will be recognized as income? For this year, I am going to record at depreciation rate. That's what you do for deferred income approach. You applied the depreciation rate. What is the depreciation life? 5 years. So at the same, I will apply 2600 divided by 5 for 9 months. How much is this? How much income will be reported? 390. This year's income to be reported is 390. So total deferred income at the reporting date is, can you do 2600 minus 390? How much is that? 2210? Yes. Now what part of it is current liability? Current liability is what will be reported in the next year as income. So what will be reported in the next year as income? We will apply again the depreciation at cost. So next year which will be going into income is 2600 divided by 5. How much is that? 520. So what's the non-current liability part of this? Non-current liability part of it is 1690. So my answer is 1690. B. Done and dusted. Yes. Now let's move on and see what we have next. Finally, section A questions. So these will be unrelated. They won't be related to any case study. So let's quickly cover them. How many questions are remaining? How many have we done? I think we are done with 30 questions. 20 to go. Am I correct? Done with 30? 20 more to go? Are we keeping a check? You can't sue me for this, okay? This is a constructive obligation. Okay, let's go. What's my requirement? What is the profit arising? What's the profit arising on disposal of coffee that will be reported in consolidated statement of profit and loss? Once again, you are disposing of a subsidiary. So you will apply that happy sad formula. So they said you disposed 60% holding. Proceeds are 15 million. So 15,000 will be added because we are happy to receive those proceeds. NCI at acquisition date was 2.2. Net assets of acquisition at disposal date were 5 million and 8 million. At acquisition date, they were 5. At reporting date, they were 8. So what's the post-acquisition movement? 3 million. NCI will have a 40% share in this. What is 40% of 3 million? What is 40% of 3,000? 1200. So NCI will have a 1200 share in that. So that would be 2200 plus 1200 is my NCI at disposal date, which is 3400. So, okay, wait. We are disposing it mid-year, 30 June. So will this full 1200 be added or only 6 by 12 of it will be added? Will you add the full 1200 or only 6 by 12? See, they have given you the reporting, not the reporting date net assets. They have given you disposal date net assets only. So you will use the full 1200, not 6 by 12. If it was reporting date, then you would have used 6 by 12. Then goodwill on acquisition was 1 million and has been fully impaired by disposal date. So what is NCI share of goodwill impairment? Goodwill impairment was of 1 million. NCI share is 0.4, which is 400. So what is my NCI? 3000 is my NCI. 3400 minus 400. 3000 is my NCI. So I'm happy to lose this NCI. So add it. Am I happy to lose the net assets? What are my net assets at disposal date? 8000. I'm sad to lose them. Is there any goodwill on disposal date? No, because it's fully impaired. So what's my profit or loss on disposal? Calculate. This plus this is 18,000 minus 8,000. What's your gain? 10,000 is your gain. So therefore my answer is profit of 10 million. I've just merely applied my happy sad formula of profit or loss on disposal. Clear? Let's move on. That was just a repetition thing. This one. Question number 183, everyone. Question number 183. What's there? Let's do it. What is the value of receivables in consolidated statement of financial position as at 31st December 2014? So there are some receivables. They are asking you the valuation of it. So on 1st January, parent acquired 80% of the equity share capital. Extract of their statements of financial position are given. What are the extracts of their financial position? We have receivables of parent and subsidiary. At 31st December, that is reporting date, subsidiary recorded a payable of 3 million, which did not agree to the parent's receivable balance due to 1 million cash in transit. So how will you calculate your cash in transit? How will you adjust for your cash in transit? How do you adjust your cash in transit? Come on, tell me. How do we adjust our cash in transit? So, okay. What you are going to say is total receivables. They are asking us group receivables, right? So, parents' receivables are 64.6. So, that plus subsidiaries receivable of 38. What were my intra-group receivables? Intra-group receivables are 3 million, but that is not matching because there is cash in transit. So what journal entry will the parent pass? Parent will pass a journal entry, cash debit, as if he has received the cash, and receivable credit by 1 million. So now I need to remove 1 million from my receivable. And then I need to remove intra-group receivables of 3 million. So can you tell me how much are you getting? 64.6 plus 38 minus 4. How much is this? Yes, 64.6 plus 38 minus 4. 98.6. Awesome. So that is coming out to be 98,600,000. That's my answer. Done with question 183. Let's move to question number 178. Here we are supposed to tell in which of the following relationships is Germany necessarily the parent. Let us read it. Where is this company necessarily the parent? Fall has 50,000 known voting and 1 lakh voting equity shares in issue, with each share receiving same dividend. And German owns Fall's known voting shares and 40,000 of its voting shares. What matters when you're deciding which company is having the control? The number of shares matter or the voting rights matter? What does matter to you? Number of shares or voting right? Number of shares, voting right. Come on, someone break the tie. What matters? Voting right matters because voting right is going to tell you how much power do you exert. So here we have non-voting shares. So they don't play any role in deciding whether we have a control or not. Out of 1 lakh, having 40,000 means 40% voting right. So is it a parent? Is Germain a parent in this case? No. 40% is not parent. So that's not the right answer. So one cannot be the right option. This cannot be the right option. This cannot be the right option. So do I need to read even these 2 points? That's how you save your time. So your answer is C only. Your answer is C only over here. Because all the 3 options had 1 in them. And 1 we decided is not the option. So the only thing which is left is option C. But if you go through them all, what is given to you? KIP has 1 million equity shares in issue. So there are 1 million shares and Germain owns 40%. Germain also owns 8 lakh out of 4 million 8% convertible loan note. These loan note may be converted. For each $100 loan, we will get 40 shares or they may be redeemed in cash. So when you have convertible loan note, that means 40% you already have a shareholding, you already have 40% voting right. There's a potential more 40% of voting right. So if you exercise these convertible loan notes, you are going to get at the end of the day 80% voting right. That's why it's a parent. So that means convertible loan notes are also giving a rise to parent subsidiary relationship. Then Germain owns 49% of the equity shares in the parent and 52% of its non-redeemable preference shares. So as a result of these investments, Germain receives variable returns from parent and has the ability to affect those returns. So 49% in shares and 52% of non-redeemable shares, preference shares. So primarily you are having power. Why? Because they are writing it here. That you have the ability to affect the returns, you have the power over the investing. Therefore, you are the parent in these 2 points. Are we guys clear? Come on, quickly. Are we guys clear on this? Any doubt? Till then I can scroll up. Okay. Question number 169, everyone. What's given to us? What is the share of profit of associate to be shown in the consolidated statement of profit and loss? So green is an associate of purple. Purple owns 30% shares in green. During the year, green made a net profit of 1.5. So purple will have 30% share in that profit. Green sold goods to purple during the year with a value of 2 million. So green has sold goods to purple during the year and the value of that sale is 2 million. Green is the associate. Associate is the seller. Associate has sold goods to the parent. And half of them are still in the parent's inventory. All the goods are sold at a margin of 30%. Margin is at selling price or cost? Margin is at selling price or cost? Selling price. Margin is always at selling price. Very good. So purple has recognized previous impairments in relation to investment in green of 2,25,000 and in the current year, Purple wishes to recognize additional impairment of 35,000. So first of all, you are supposed to calculate what would be your share of PURP. How will you calculate PURP? PURP will be calculated as 2 millions 30% because that's our margin. What's that? What's my PURP coming out? 30% of 2 million, guys. 600. But only half of the goods are still in the inventory. So this comes out to be 300. But you only have 30% share in this. This comes out to be 90. Am I right? So my PURP is coming out to be 90. I need to remove this. Who's the seller? Associate is the seller. So I need to remove this from my share of profit in associate. 90 will be removed. Then what's your impairment loss? 35,000 is the impairment. So how much will you show? They are asking you your share of profit in associate. So you will say my share of profit in associate is total profit of associate is 1,50,000. That is 1.5 million. So I am going to have 30% in that. So 30% of 1.5 million. This is 4,50,000. Then I'll remove PURP from this. The PURP we calculated was 90,000. Yes. And then we have impairment. Impairment is given to us at 35,000. What's our share of profit in associate? Come on quick. What's our share of profit in associate? $3,25,000. So that is what I'm going to report. Come on. Next. We're done with this question. This is goal related to consolidation. So no more questions. One question once again. What is the adjustment to inventory that would be included in the consolidated statement of financial position of MNO at the year end resulting from this sale? What sale are they talking about? And they're asking about the adjustment to inventory. So MNO has 75% owned subsidiary PQR. During the year, MNO sold inventory to PQR. Once again, intra-group sale. So parent is selling goods to the subsidiary here. Invoiced price is 8 lakh. So selling price is 8 lakh. And the subsidiary have sold 75% of that inventory. So only 25% remains in the closing stock. 25% remains in the closing stock. The sale was at a markup of 25%. So you need to calculate your PURP here. That's what they're asking. Can you calculate the PURP quickly? What would be my PURP in this case? My PURP would be, we'll apply the normal formula. Our total sale is of 8 lakh, right? So you will say 8 lakh into 25 by 125 because it's a markup, or you can do that let the cost be X method. So what you get as your PURP is 1,60,000. But out of this, only 25% are still in the inventory. So this comes out to be 40,000. My answer is B, 40,000. Yes. Next. Done with the consolidation. IS 10. Which two of the following which occur after the reporting date of an entity but before the financial statements are authorized for issue are classified as adjusting events in accordance with IS 10? Which two of them are adjusting events? Read it. First, change in tax announced after the reporting period. Is that an adjusting event? No. We just discussed it. The discovery of a fraud which had occurred during the year. Yes, it's an adjusting event. The determination of the sale proceeds of an item of plant sold before the year end. The determination of sale proceeds, is it adjusting? Which was sold before the year end. You have sold the plant before the year end and you are determining its sale proceeds after the year end. So of course it is adjusting. Fire is non-adjusting. So done with this. Next, EPS part, I'll be doing it via a video lecture. Let's move on. Yeah, this one. IFRS 15, contract asset. Very important. What is the value of contract asset to be recorded in Sawyer's statement of financial position? So Sawyer company has entered into a contract to construct an asset for a customer during the year. And this has to be satisfied over the period of time. So you need to apply those 4 steps. Do you guys remember those 4 steps? When we recognize the revenue over the period of time? First, you need to calculate your overall profit, and then there are further 3 steps that you have to follow. Last step is where you calculate whether it's an contract asset or a contract liability, right? So what I will do here, I am given that Sawyer recognizes progress towards completion using input method. And based upon the cost to date compared to total cost, the following information is given. My contract price is this, cost incurred till date is this, estimated cost is also given, work invoice to date is also given. So I will quickly just go to my board and make my 4 steps. What's my 4 step? Step number 1, is it an overall profitable contract or not? So my contract price as per the question was how much? Contract price is 1 million. What's my total estimated cost? That is cost incurred till date plus estimates. What's that? Let's see. Till date we've incurred 5 lakh, estimate is 3 lakh, so total is 8 lakh. Is it becoming profitable? Yes. So there's a profit, overall profit of how much? 2 lakh. So it's a profitable contract. So I need to calculate my progress. So what's my step number 2? My step number 2 is to measure the progress. What is my progress? As per the question. Come on. The progress is calculated using input method. So out of total estimated cost of 8 lakh, I have incurred 5 lakh of the cost. So out of total estimated cost of 8 lakh, I have incurred 5 lakh. So what is my percentage of completion? Come on quick. What's my percentage of completion? 62.5%. Very good. So the work completed is 62.5%. Then what else? Now in step number 3, what do? You recognize the revenue. So let us recognize our revenue. Step number 3. How much revenue will you recognize? Total contract price into 62.5%. So you will recognize 1 million into 62.5, which is 62,500. This is the revenue that you will recognize. And how much amount have you billed, guys? You have billed the customer for 6 lakh. You have billed the customer for 6 lakh. So the work done till date is of worth 6 lakh 25 and you've just charged the customer 6 lakh. So what is your contract asset? What's your extra work that you've done? What's your contract asset? 25,000. So my answer is contract asset of 25,000. So these are the steps that you follow to calculate your contract asset or contract liability. Right? So we've done very major portion of IFRS 15. Usually that's asked from IFRS 15. Then which of the following items have correctly been included in Hatton's revenue for the year? Which of the following have been correctly included as revenue? You will tell me. Come on, read this question. First, which one of it is correctly included as revenue? A 2 million in relation to fee negotiated for advertising contract. One of Hatton's clients, Hatton acted as an agent during the deal and is entitled to commission. So agency concept applies. If you are an agent, you are just entitled to the fee or the commission. You are not entitled to the full contract price. So this is incorrect. You should not have recorded the full contract price as your revenue. Then 5 lakh related to sale of specialized equipment on 31st December. The full sales value was 7 lakh, but 2 lakh relates to servicing that Hatton will provide over the next 2 years. So Hatton has not recorded that in the revenue. So Hatton has sold an equipment. When we sell an equipment, it feels like it's a sale of non-current asset. But it is given to us that we are even giving them services for, we are servicing that plant. That means our normal course of business is to sell this equipment. Right? So we've sold an equipment and our normal course of business is to sell equipment only. So the full sales value of 7 lakh, but 2 lakh relates to servicing, which we have not recorded. So that's correct. You should not have recorded it. Why? Because it would be recorded over the period of time. So this seems to be correct. 8 lakh related to sale of some surplus land owned by Hatton. Is this revenue? Is this IFRS 15? If I sell my land and property, is that revenue? No, this is not revenue, not normal course of business. Then $1 million in relation to sale to a new customer on 31st December. Control passed to the customer on 31st December. 1 million is payable on 31st December 2003. So yes, when you transfer the control, that is when you record the revenue. But you should have recorded it at present value because you will receive the money 3 years later. So you should have recorded it at present value and not at 1 million. So this is also incorrect. So my correct option is only option B. Right? So that being done, let's do the next one. Question number 106. How many questions have we done till now? Were we able to maintain any record? How many questions have we done? How many questions done? Come on, quick. No record? The record keeper left. Okay, check the recording and see. Okay. 45 are done. Kittu thinks 45. 38. 39. Okay. 49. Arshad wants to leave the session. Okay. 39 are done. Fine. 39 are done. Let's move on. Here they're saying select the correct amount to be shown in revenue and cost of sales in the statement of profit and loss. So once again, they're asking you something related to that 4-step approach. So I kept one more question to practice that 4-step approach because it's very important from revenue. So CN started a 3-year contract to build a new university campus. The contract has a fixed price of 90 and it will be satisfied over the period of time. The costs which we have incurred are 77 million and estimate of further cost is 33. We measure the progress on the basis of contract price. That means work completed compared to contract price. So we use the input method. Work completed means output method. Yes. So surveyor valued the work completed as 63 million. So what are you supposed to do? Come on. 4 steps. They are asking about what will go into cost of sales also. That's why I picked up this question. So step number 1. Overall profit or loss. Contract price as per the question is given to you at. What's my contract price? 90 million. So contract price 90 million. What is my total cost? Estimated cost and total cost incurred. So total cost which is incurred till date is 77. and the estimate is 33. Is it an overall loss-making contract? Yes, it's a loss-making contract. So how much loss is there? Loss of 20. What do you do with loss-making contracts? Do you measure the progress? Do we measure the progress? Yes, we do measure the progress. So what do? Let's measure our progress, but then we'll record the full loss in our P&L. So my progress is based upon the work completed. Total price is 90 and they have said that we have done work of 63 into 100. What's the percentage of work done? 70%. 7 nines are 63. So 70% of the work is done. So in my statement of profit and loss, what would I do? That's my step number 3. In my statement of profit and loss, how much revenue and how much cost of sales needs to be reported. So revenue reported is 70% of 90. What is 70% of 90? 63 million. How much cost of sales are you going to report? See, you will report the full loss of 20. Revenue minus cost of sales is loss. So you should get a full loss of 20. So how much cost of sales should you report? Balancing figure. What's your balancing figure? 83. If I will, 63 minus 83 is minus 20. So this 83 is the cost of sales that I need to report. So this is a tricky question where there was overall loss. So what's my answer? Revenue 63, cost of sales 83. Important, star. Next. Let's move on. 102. Related to PPE. So what is the carrying amount of the machine? They are saying a machinery manufacturing entity buys a machine, an item of PPE for 20 million dinars on 1st January 2001. The machine is held under cost model and has a useful life of 20 years. The entity has a reporting date of 31st December and a functional currency of dollars. So they have given you the opening value. Opening value is 20 million dinars of this machinery. And the life of this is 20 years. So you will apply depreciation to this. So then they have given you the closing value. You will calculate in dinars and then you will convert it, retranslate it. So they're asking you in dollars the amount. So I want you to try it. Come on. I've given you the direction. They're asking you the carrying amount at 31st December in dollars. Try this question. Quick. I give you next 2 minutes. Try this question. Yes. What's my answer? Answer is C, 9.5. How are we getting this? Initial value is 20 million dinar. So you use your initial rate. What's your initial rate? $1 is equal to 2 dinar. So I would divide 20 with 2. So I get 10 million. That's my $10 million amount. Initial value. And then I need to depreciate it. What is my depreciation? My depreciation is 20 divided by 20 years. 1 million dinar is my depreciation. I need to convert this in dollars. So in dollars, depreciation is converted at which rate? What would you do for depreciation? Do you convert depreciation? No. So simply 20 minus 1 is 19. Now convert this 19. What should you do for this 19? What rate should you apply to this? Would you do anything to it? No. You'll simply depreciate this because you keep your asset at historic cost. So you will apply 20 years life on this. So 10 million divided by 20 years, my depreciation comes out to be 0.5. How much is this? 0.5 only, right? So what is 10 minus 0.5? It is 9.5. So that's why my answer is option C, 9.5. I don't do any conversion for depreciation at the closing part. I simply do it in dollars directly. So my answer is 9.5. Next. Okay. How much should be reported in equity in relation to the loan note? How much should be reported in equity in relation to the loan note? On 1st October, Burton issued 10 million convertible loan note which carry a coupon rate of 5%. The loan note are redeemable on 30 September at par for cash or can be exchanged for shares. The similar loan note has a rate of 8%. The present value of $1 receivable based upon discount rate of 5 and 8% are given to you. So what we will do, we'll simply calculate present value of all the future cash flows. So what are my future cash flows? 10 million convertible loan. My future cash flow is 5% coupon rate. What's my coupon rate? My coupon rate is given to me at 5%. So I'll receive 5% of 10 million each year. So year 1, year 2, year 3. My cash flow is going to be 500 in year 1, 500 in year 2, which is 5% of 10 million, working in thousands. And in year 3, I will receive 10,000 plus 500, that is principal and interest both. What will be my discounting rate? Discounting rate is 8%, which is to be used. So they have given you the discounting factor 0.93, 0.86, 0.79. So let's use that 0.93, 0.86, 0.79. What is the present value coming out? Come on, quick. 500 into 0.93. 465. Then in year 2, 430. Year 3. Yes, year 3. 8295. So total comes out to be present value. $9,190. So my total financial liability part, my total proceeds are 10,000. Out of this financial liability is 9,190. So what's my equity? Balancing figure. What is equity? 810. So my answer is 810. So that's your answer. Let's move on now. Convertible loan notes done. 91 and 92. What is the gain to be recognized on these shares on 31st December 2014? So ABC purchased 10,000 shares on 1st September, making the election to use the alternative treatment under IFRS 9. That means you purchased 10,000 shares. What is alternative treatment? Alternative treatment is OCI, fair value through OCI. Because by default method for shares is fair value through P&L. And this company has opted for alternative method. So most probably they've kept it for fair value through OCI. So the shares cost was 3.5 and transaction cost with the purchase were 500. So at 31st December, the shares are trading at 4.5. So per share, see what will you do? Initial value of your shares would be 10,000 shares into 3.5. That is how much? 35, right? 35,000. Then you have a transaction cost of 500. So add that. So total comes out to be 35,500. Yes. Now what's our closing value? Our closing value is 10,000 shares into 4.5. That is 45,000. So how much gain have you made, guys? 45,000 from 35,500 to 45,000. 9,500 is the gain. This is reported in the OCR. Then, how much income should be reported in the statement of profit and loss for the year ended 30 June to the nearest thousand? So, what is the income to be reported in the P&L with regards to this? What is given to us? Let's see. On July 1st, an entity purchased a 5-year loan note investment with a par value of 7 million. The investment was purchased at 12% discount. So this is important because we are buying this investment at discount. The loan note has a coupon rate of 5% and effective rate of interest is 7%. Interest is received annually in arrears. The entity has an intention of holding the loan note to receive the full amount. Which method to follow? Because they are saying we want to keep it till maturity, so I'll follow amortized cost method. Yes. So let's follow amortized cost method. They're asking us what will go into P&L. So what we will do? We have issued this loan. We have purchased this loan, which was of 7 million. We have purchased it at 12% discount. So that means initially, on which date have I purchased it? 1st July, right? So what is my brought forward for year 1? Because it will be repaid on 31st. It is to be repaid in 5 years time. Okay, fine. It is to be repaid for 5 years time. But they are asking me what will go into my P&L for 30 June 2009. So I need 2 years gain because my year 1 is 30 June 2008. My year 2 is 30 June 2009. So they're asking me this. So my brought forward amount is 7 million into 88% because 12% you got a discount. So what's your purchase price? Your purchase price is 7 million 88%, which is how much? Come on quickly. 7 million 88%. How much is that? 6160. So my brought forward in year 1 is 6160. So brought forward opening asset plus interest minus cash received gives you closing asset. So your interest rate as per the question, effective interest rate as per the question is 8%, right? The effective, sorry, what's my effective interest rate? As per the question, loan note has a coupon rate of 5%, effective interest rate is 7%. So I will use 7%. So what is 7% of 6160? What is 7% of 6160? Plus 431. Yes, plus 431. Then what's my cash received? My cash is received at 5%. So how much cash am I receiving, guys? I'm receiving 5% of 7. So that is 350. 7 fives are 35. So 350. What's my closing asset? What's my closing asset? Yes, come on. 6160 plus 431 minus 350. What's my closing asset? 6241. So next year's opening is also 6241. Once again, 7% of this. How much is that? 437 minus 350. What's my closing asset? 6328. So what do they want me to give as my answer? They're asking me what will be my finance income in the P&L for the year 30 June 2009. So what will be my finance income? 437. So my answer is 437,000. What's my answer? 437,000. So let's write it and move on. 437,000 is my answer. Okay. Next. Yes. They're asking you in the statement of changes in equity for the year ended 31st December 2015, what adjustment will be necessary to the retained earnings brought forward? So on 1st January, Badger entered into a lease agreement to lease an item of machinery for 4 years. So my lease term is 4 years. Fine. Then what are they doing with this? If our lease term is 4 years, they're saying rentals of 2,10,000 are payable annually in arrears. The asset has a useful life of 5 years, and at the end of the lease term, legal ownership will pass to Badger. So the present value of the lease payment at inception of the lease was this. So when the ownership at the end of the lease is passing to the lessor, should I depreciate the ROU at the life of the asset or at the lease term? If at the end ownership is transferred to the lessor, very good. I should be depreciating my ROU at the life of the asset because at the end it is getting transferred. Very good. The present value of the lease payments at the inception of the lease was this, and the interest rate implicit in the lease is 12.2%. So for the year ended 31st December, Badger accounted for this lease by recording the payment of 2,10,000 as an operating expense. This treatment was discovered during the 2005 and the financial statements have been finalized. So what have they done? They've recorded this whole 10,000 rent that they've paid as an expense. Is it correct? Are you not supposed to record your ROU and the lease liability? They have totally forgotten about it. They have not recorded their ROU and the lease liability. So what I will do? Let us see. Let's go to the board. we'll say what they have done. They have recorded an expense. The entry that they've passed is expense debit by 2,10,000 and they've created a corresponding liability for this. This is the mistake that they've done for the rent paid. So what I will do, I'll say this is wrong, so I need to reverse it. So how will I reverse it? I'll say liability debit, expense credit. By crediting the expense, I mean group retained earnings credit, because I'm talking about I've reached the next year already. This whole thing happened on 1st January 2004. It happened in 2004 year. And I've already reached 2005. So this is all previous year's mistake, prior period error. So I will credit my group retained earnings. In my statement of changes in equity, I need to increase my GRE by 2,10,000. Then what next? I need to create my ROU. I need to create my ROU. What's my ROU? Let us see. You've entered into a lease agreement to lease an item of machinery. So when you are going to, receive this asset at the end of the day, do you record, what do you record? ROU or the whole PPE? You record the ROU only. You'll record the PP when you actually receive it, but you'll depreciate that ROU. So you'll record an ROU. Let us see what we will do. When we record the ROU, we record it at lease liability. What's our lease liability? They've said that your lease payments were 6,35,000. So you will say ROU debit lease liability credit 6,35,000. Now, since you have recorded it, you must be depreciating it also. So depreciation will happen at the life of the asset. What is the life of the asset? 5 years. So what's your depreciation? Your depreciation is, come on, calculate your depreciation. 6,35,000 divided by 5. How much is that? 6,35,000 divided by 5. How much is that? Yes. It is 1,27,000. Very good. So 1,27,000 is my depreciation. So what's my journal entry? This will again impact my GRE. So I will say debit my retained earnings, credit my ROU by 1,27,000. Right? So what will happen next on lease liability? What's your subsequent treatment on lease liability? You need to unwind the interest. What's your cost of capital? What interest rate implicit in lease? 12.2%. So your entry is finance cost debit, which again impact your retained earnings, and lease liability credit. What is 6,25,000's 12.2%? What is 6,25,000's 12.2%? I'm doing the subsequent treatment of lease liability. What is 6,25,000 into 12.2%? Yes. How much is that? It's 6,35,000. Sorry. It's 6,35,000, not 25. 6,35,000 into 12.2%. Yeah, we have taken 6,35,000 above. So 77470. So 77470. So what is going into your statement of changes in equity? Come on, tell me. In all the journal entries that I've passed, what goes into statement of changes in equity? Is ROU there in statement of changes in equity? No. Is lease liability there in statement of changes in equity? No. What is there in statement of changes in equity then? Only the GRE. Only the GRE is there. So what's my impact on GRE? In total, what's my impact on GRE? First, you increased your, see, first you increased your GRE by 210. Then you have decreased your GRE by 127. So 210 minus 127. Then deduct 77470 from it. So what's my total impact? 210 minus 77470 minus 127. So what's my net adjustment? What's my net adjustment on this? 210 minus 77470 minus 127. Very good. So my net adjustment is increase my GRE by 5530. So that will happen in statement of changes in equity. So option A, credit the GRE by 5530. That's it. Let's move on. Question number 80, everyone. What's there? Question number 80. What will be recorded in Rabbit's financial statement in respect of the lease liability? So once again, they've asked you what finance cost will be there, what would be the non-current liability, what would be the current liability. How do you calculate your lease liability? Opening lease liability plus interest minus cash paid gives us closing lease liability. What's the current portion? How do you calculate current portion? Compare year 1's closing lease liability with year 2's closing lease liability. And that movement is current portion. So let's see what would be our answer over here. What would be our answer over here? Let us see. They're saying on 1st January, Rabbit acquired a new machine with a useful life of 6 years. Initial payment is this, which is payable immediately. 5 further annual payments are 20,000, which will be due commencing 1st January. The interest rate implicit is 8%. So am I making the payment in arrears or in advance? Am I making the payment in arrear or in advance? The payment is being made in advance, beginning of the year. So how will you calculate? You're supposed to calculate for how many years? They're asking you the amount for 31st December 2004. So you need to calculate for 2003, 2004 and 2005. So for 2003, year ended 2003. What's my brought forward amount? Brought forward lease liability. Total lease liability is given to you as, what's your lease liability? 86240. So take this 86240 initially, opening lease liability. From this deduct the payment that you've made, 20,000 is the payment. So you get 66240. In that you are going to charge interest at 8%. What's that 8% of this? What's the 8% of this? Yes, 8% of 66240. 5299. Very good. So add 5299 to this. What's your closing lease liability? This plus this. What's the closing lease liability? Very good. 71540. So next year's opening, 71540 minus 20,000. That gives me 51540. On that, I will charge 8% interest. How much is that? 8% of 51540. Okay, this is 39. This is 39. 4123. So closing is 55662. And then 2005. Opening would be 55662. You are making the payment of 20,000. So what do you get? 35662. Will you charge interest on this? Will you be charging interest on this? Yes. Will I charge interest on this? See, this will give you your current non-current. You don't need to calculate total liability for year 3. Now what they're asking in the question is what's your finance cost? So first of all, your finance cost is 4123. So 4123, where I can find this? I can only find it in option A. The moment I see 4123, I will close my search. I will close my calculation. So current liability would be 20,000, obviously the amount that is due in the next year. And the non-current liability would be the remaining. What is the non-current liability? 35662 is the non-current liability and 20,000 which is to be paid because you are paying it in advance. So that's your current portion. So my answer is A. So the moment I see 4123, my search for this question would stop because then if I check my options, only one option has 4123. Are we guys clear on this? Yes or no? Come on quickly, chat box. Are we guys clear? Any doubts? Yes, our record keeper. How many questions done? Where's our record keeper? I think it was Sunil, right? 45 questions done. 5 more questions to go. Come on, quickly. Which two of the following statements regarding Boyne Company's inventory are true? So Boyne manufactures cycling equipment. It has number of specialized frames in which inventory cost them 20,000 to manufacture. So my cost of inventory is 20,000. These frames are manufactured following an order from customer at an agreed selling price of 30,000. So my selling price is 30,000, cost is 20,000. Due to recent technological advances, the current cost of manufacturing is estimated to be 15,000. Boyne has also inventory of 3,000 pedals with a cost of 20 each. These have become damaged. So if Boyne spends 5,000 to repair all of them, it could be sold for 21 each. So there are two things. We have to talk about frames and we have to talk about pedals. First, let us talk about frames. What do you think? At what amount should I keep my frames at? At what amount should I keep my frames? Yes, I need to keep them at lower of cost and NRV. So what's my cost? My cost is 20,000. What's my NRV? What's my NRV? NRV is fair value minus cost to sell. Is there any fair value given? Yes, 30,000 is the fair value, agreed selling price. This current cost, does that matter to you? How much is the cost today for manufacturing? You see your cost, no? If you have an asset, at what price did you buy it? Its current cost does not matter because the fair value is given to us at 30,000. So what is lower, 20 or 30? I should record my frames at 20,000. So where can I see frames valued at 15? No. Frames valued at 20, right? So B option is correct. For pedals now, what's my pedals cost? There are 3,000 pedals and their cost is 20 each. So that comes out to be 60,000 is my cost. What's my NRV? Net realizable value. They said they have become damaged. They need 5,000 repair. So that would be cost to sell. Fair value is 21. So I'll say 3,000 into 21. How much is that? That's my fair value. How much is that? 3,000. 63,000 minus repair of 5. What is 63 minus 5? 58. So at what amount should I report my inventory at, my pedals at? 60 or 58? Which is lower? 58. Awesome. So my answer is B and E option. I need to report them at lower of 2. Done with that. Let's move on. Yeah. Question number 36. What should be the carrying amount of the property in Tilly's statement of financial position? At 1st April, Tilly owned a property with a carrying amount of 8 lakh, which had a remaining estimated life of 16 years and was carried under the cost model. So there was a property whose carrying amount was 8 lakh, remaining useful life was 16 years, kept under cost model. On 1st October, it was decided to sell the property and classify it as held for sale. The property agent reported that the property's fair value less cost to sell was to be this. So what should be my carrying amount at 31st March? So this one relates to IFRS 5. What does IFRS 5 tell you? That whenever any property is held for sale, you are supposed to report it at lower of 2 amounts. Lower of carrying amount and fair value less cost to sell. So what's your carrying amount? Let's calculate. Opening carrying amount is 8 lakh. Life is estimated to be 16 years. So what is the depreciation? We need to calculate our depreciation on 1st October till 1st October. How many months are there? April, May, June, July, August, September. 6 months. So my depreciation is 8 lakh divided by 16 into 6 by 12. How much is that? How much is that? 25,000. So what's my carrying amount, guys? 8 lakh minus 25,000. 7 lakh 75. And what's my fair value less cost to sell? 790,500. So I should report it at 7 lakh 75, which is the lower amount. Done. Are you sure we're just done with how many questions? How many more to go? 3 more. Okay. At what value should the property be reported in Dune's statement of financial position? At 30 September, what do I have? Dune's property in its statement of financial position, cost is given to me, cumulated depreciation is given. And on 1st April, Dune decided to sell the property. The property is being marketed by a property agent. Year end is 30 September. On your 1st April, you've decided to sell. How many months? October, November, December, January, February, March. 6 months. So 6 months into the year, you've decided to sell. The price is 42, which was considered a reasonably achievable price at that date. The expected cost to sell have been 1 million. Recent market transactions suggest that the actual sales price achieved for this type of property in the current market conditions are 10% less than the price which has been marketed. So what should I take? See, I would say my cost of asset, first of all, is 45. I need to depreciate it, right? So cost is 45. I need to depreciate it. What's my depreciation? 45 into divided by 15, that is the life of the asset, into 6 by 12. What's my depreciation? What's the depreciation? 45 divided by 15 into 6 by 12. 1.5. What's your previous depreciation till date? 6 million. So what's your carrying amount on 1st April? What's your carrying amount? 37.5. Now you need to determine your fair value less cost to sell so that you can actually understand that what's your amount to be reported. So you will take current market conditions. So my current fair value is how much? 42 million, but they're saying as of now you can sell it at 10% lower amount. So what is your fair value? 42 millions 90%. What's 42 millions 90%? 42 millions 42,000 90%. 37,800. But then what is my cost? 1 million, that is 1,000. So my fair value less cost to sell is 36,800. So what is lower? 37,500 or 36,800? 36,800. So this is once again, I'll record it at lower amount. So my answer is C. Okay. Have I even circled any more questions? No. Yeah. So as per me, I am done with my top 50 questions. So the extra 2 questions, you can try any two randomly. Okay. So majorly these were those important questions which I wanted to discuss with you from your MCQs. So today we have done questions on consolidation, associate, subsidiary, everything. We've done questions on IS 37, which got revised. We did question on IS 10. We did question on IS 21. We did question on IFRS 15. We did question on IFRS 16. And we also did question on IFRS 9. And we even did question on IS 36. Impairment, government grants. We did question on IS 16. We did questions on IS 38 and even IFRS 5. So see, we've revised so many standards today with the help of MCQs and even IS 12 deferred tax was also there. So this is how, if you pick up questions, you can easily cover your concepts along with them. And now, as I promised, I will share the Super 20 Section C questions with all. Also for the students who would watch the recording on the YouTube. So for them also. See, this is the Super 20 question list. Like this is the planner which my batch would be following. The regular batch, post-result batch, and the crash batch students. These are the questions that I've given them since 5th of February. The test, group accounts test has been done. Tomorrow they are having their single entity test. And These are the Super 20 questions, which I am giving them in a recorded form. These, and these. So if you guys want to do the Super 20 questions, what I mean by Super 20 is not that you will just do these questions. You are supposed to do all the questions of the kit. As you can see clearly in my planner, I've told my students to practice questions, self-practice also. But these Super 20 questions are the questions which I have to type and practice. Seriously type and understand. Like today we did 50 MCQs. We've got our perfection in 50 MCQs. If at any point in time during this session you felt lost, go back to the recording. Tomorrow it will be available. So 50 MCQs, I'm sure it must have given a lot of confidence to you. That today you touched up so many standards, especially the people who are here till the end. So I know if our students don't have that much motivation to study, so it's okay that, this is something which will give us confidence. Even if you watch it as a recording, all the students would watch it as a recording also. I'm sure this has helped you. Similarly, if you pick up some random questions and practice them, apart from the random questions, I've cherry picked some questions for you. I've been teaching this subject since 4 years. So I know that which section C question is having a difficult adjustment within it. Okay, this one has something related to NCI which is difficult. So I picked up that and written it as a question to be practiced. So if you guys want to practice these questions as like my debrief, if you want my debrief on them and you want some important concepts coverage along with the debriefs of Super 20 questions, and if you want to get your assignments marked, like tomorrow we have our single entity test, then we have our interpretation test left. Rest of the tests have already happened, right? And then you will have your mock exam. So if you want to give these assignments, mocks, important question debriefs, and important concept debriefs, then you guys can enroll into a crash course, which is available. You can see that crash course on TG Prof's website. You can visit our website, TG Profs, and you can enroll from there. And anyways, I'll be giving you a guidance on EPS and interpretation. So tomorrow, guys, this video will be uploaded on YouTube. Day after tomorrow or one day after that, you will get EPS and interpretation as well. Like just a guidance session on both of these. So that's it from my side. Yes, K2 on portal also, it will take time. It will be available tomorrow only. So all my students who are enrolled with me, guys, tomorrow we are having a single entity test. I can see a lot of you here sitting here, and all those students who joined from the free group. I hope it was a fruitful session. I didn't waste your time. You enjoyed the session. You must have got some confidence. And the students who are here from my batch, we have a test tomorrow. Okay. And single entity questions. So that means our interpretation will be day after tomorrow. So if our test single entity test is tomorrow, day after tomorrow, you will start with interpretation. Clear to all? All my enrolled students? Yes? Okay. So that's it, guys. Thanks for joining in and see you in the grand revision now with the conceptual video. And take care, goodbye, good night, and all the best for your exam. May you all pass with flying colors. I hope it was a fruitful session. Stay connected through the WhatsApp groups. Take care, goodbye, good night.